Good morning, everyone. It's 9 a.m. here in New York City. I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance Live, and here is what we're watching this morning. Rate cut expectations get a reality check over the weekend. Two Federal Reserve officials push back on the market's bets for early 2024 cuts, but the bulls can't be stopped. Goldman Sachs lifted its 2024 forecast again.
And let's make a deal. U.S. Steel agreeing to sell itself for almost $15 billion. The buyer, well, it's Japan's largest steelmaker, Nippon Steel. The deal capping months of speculation and marks a new phase for the once almighty U.S. industrial giant.
And China's iPhone ban ramping up across state and government-backed firms, according to Bloomberg. Apple's market share in China also at risk thanks to the rise of Chinese-owned Huawei as the nation looks to ramp up domestic production.
Well, the Federal Reserve's dovish pivot has Wall Street feeling a bit more optimistic about where we're headed in 2024 after Fed officials signaled that 3 interest rate cuts for 2024 could be likely in their dot plot. We have Goldman Sachs chief U.S. equity strategist David Kostin. Well, he's out with a new call on the S&P for next year. He raised his S&P 500 forecast to 5,100 by the end of 2024. Now, that's up from his previous call of 4,700 just a month ago. And Brad, we have certainly seen this risk-on rally that seems to be really driving the markets over the last several weeks. You can say just anticipation of this pivot that we could have gotten here from the Fed, although we do need to point out that Fed Chair Jay Powell was very quick to couch just in terms of the fact that they are still data dependent, that if in fact we don't make any more headway in the fight against taming inflation, they may be then forced to act. But we do see Wall Street really holding on to this optimistic view right now, very bullish about what next year could hold if in fact we do see the Fed eventually pivot and cut rates before year end.
Yeah, and there you're taking a look at some of the forecasts street-wide here. And one of the huge things that Goldman particularly pointed out within their note, the stronger view of the equity market also dovetails with the colleagues' upgrades to the U.S. GDP growth plus interest rate outlook. So that exactly what you were speaking to a moment ago. Looking forward, they also mentioned the new regime of both improving growth and then falling rates should actually support stocks with weaker balance sheets. Interesting, particularly those that are sensitive to economic growth. So a few of the call outs here within those conversations that they're having with clients, but largely taking a look out to next year and becoming just a little bit more bullish. We already talked last week about how much hopium perhaps there is in the tape as of right now as we go into kind of this year-end rally and have been in this year-end rally mode. Just a longer kind of question mark, though, as to where some of the additional catalysts are going to come from next year.
And then, of course, the question is what this is going to do to deal activity, what this is going to do to the IPO outlook. Kostin briefly weighing in on that just in terms of the fact that if we do see a pivot here from the Fed, if we do see lower rates, that obviously will likely boost some of the activity that we have been waiting now for some time. There was some hope that some of that activity was going to get a bit of a surge here in the final months of the year. That hasn't exactly come to fruition. So as we look ahead to 2024, this optimism right now, more or at least bullish just about what exactly that IPO market could look like next year.
Absolutely. Well, Wall Street bulls are charging into the new year. Signs of a soft landing for the U.S. economy have pushed the S&P 500 index up nearly 23% this year, with more strategists optimistic over the Federal Reserve's dovish forecast on interest rates next year. But is it too early to be this bullish? Our next guest doesn't think so. He sees the S&P hitting a new high at 5,500 by year-end 2024. Joining us to break down the market outlook in the year ahead, we've got here on set with us Jay Hatfield, Infrastructure Capital Advisor, CEO, and Yahoo Finance reporter Madison Mills, also joining as part of Yahoo Finance's 2024 Investor Guide. Jay, great to have you here on set with us. First and foremost, what is the biggest risk to your outlook here?
Thanks, Brad and Shauna, for having me on in studio. Well, if you really track back to what our non-consensus call was, we had a 4,500 target, which is actually more bold than our 5,500 relative to what all the other strategies are at, and really focuses on Europe. Most U.S. investors, rightly so for equities, don't focus on Europe, but we're fixed income investors primarily. And Europe is in a recession. They have a GDP now, which you can access on the web. They're tracking negative 1.6%. This quarter, they were negative 0.4 really, if you annualize it last quarter. And so we think the ECB is going to be forced to cut first, which will give the U.S. Federal Reserve cover. And in fact, if you look at the futures market globally, every OECD country is projected by the futures market, not us, to cut rates by an average of over 150 basis points. So it's really more of a global focus, because I am nervous. You saw some Fed officials about the Fed. They are still in their Phillips curve mentality that we have to have a recession to eliminate inflation. But that's really the heart. So I would urge your viewers to focus on Europe and see when the ECB cuts, because they're probably going to be first.
Yeah, Jay, I wanted to bring up the whole aspect of rate cuts and how much of your call really hinges on that, because like you just alluded to, we heard from Austan Goolsbee, who was out making comments over the weekend, just saying that it is still too early to really call a victory here in the fight to tame inflation just a little bit. What are you forecasting in terms of that more aggressive outlook that you have for next year? I know a lot of it depends on what we see internationally, but how much of that, I guess, is factored in terms of Fed rate cuts and what exactly that looks like?
Well, that's a spectacular question, because you should never quote multiples without talking about interest rates. So we have a discounted cash flow multiple. And so roughly every 25 basis points is a full S&P multiple. So we're forecasting 3.5% on the US 10-year. So what's great about our simple model is you could say, oh, well, I don't believe that. I think it's going to be 4. Well, then you take 2 multiple points out, which is roughly 500 points. So you could get down below, actually, those targets you just put up there. So it is really based on an optimistic view on interest rates. But that has been unfolding. And like I said, now it's actually consensus we're going to have cuts. It's not 2 months ago, we were saying Europe was going in recession and there were no expectations. Now it's really globally. So if that unfolds, then our case is likely. And I would say the risk is to the upside on our case because of a potential AI overvaluation. So you could get 21, 22, 23 times, assuming rates are, or in fact, rates could go to 3 even if we do have global rate cuts.
Can you talk about that a little bit more, AI overvaluations? How is that playing into the outlook that investors should have this year?
Well, you know what's something strange that I learned from being an investment banker is it's actually efficient to have massive overvaluation. And the reason for that is when you have new technologies, the time to market is more important than efficiency to market. So if you create a Google in 2001, even though you had a web van, you're ahead of the rest of the world. So that's why the US always beats other countries to the market, because we have a more efficient capital market. And strangely, to be efficient, you need overvaluation with regard to brand new technologies.
You know, as we think about so many different areas that investors are going to have to consider and think about next year, there's so much of the demand environment, especially within housing, that's also going to be catching attention, because there's all of the trickle through from what people are paying in shelter and how much that has been the stickiest form of inflation as well. What's your outlook there?
Well, that's another great focus, because really, if you want to predict the economy, both inflation and GDP, housing is the most important. It's the most cyclical. It always cracks in a recession. Average recession, you have 870,000 starts. We now have 1.4 million. So that's the key to stay out of recession, because some bears are predicting recession, which doesn't seem to be the case because we have a shortage, but it's also a key driver of inflation. Actually, housing prices are rising, but thankfully rents are cooling. We have 440,000 new apartments coming online this year. So that's why we don't think inflation is going to accelerate and the housing market will be okay. But if we are wrong, it would be centered around housing, a crash, or inflation rocketing higher.
I don't want to let you go without talking about the China elephant in the room. You say that we're mispricing the growth story to come from China. Where am I missing that in my understanding?
Well, you know, of course, being negative makes everybody popular on press, and so we're typically not very popular.
Don't be popular.
Yeah.
Just say what's right. Yeah.
But if you really look at China, there's a dynamic that people don't appreciate. They save 45% of their GDP every year. We save about 20. So they have built-in growth, because if they invest just adequately, they will grow.
Right.
And if you really look at the projections, they're really going to grow about 5 or 5.5, which kind of makes sense. That's sort of not that great return on 45%. But everybody focuses on the housing market because that blew up in the US and it makes great headlines. And it is terrible, but it's an advantage of a communist country is they can go bail it out at a moment's notice. They don't have to pass it through Congress. And also, they already have loose monetary policy. They're already expanding their monetary base and lowering rates because those are linked. So that's why we're not super bullish on China, but we're bullish that they'll continue to consume oil and prop up our market. And we think today's weakness is really just seasonal. It's raining, but it's super warm in New York, and that's why oil prices are depressed.
All right, Jay Hatfield, always great to get your insight. Thanks so much for joining us here in the studio. And of course, our thanks to our very own Madison Mills as well. We'll keep her here on Yahoo Finance because there is much more to look forward to over when we talk about looking ahead to 2024. Be sure to tune into our interview with David Marisol. He is Goldman Sachs' chief U.S. economist. That's at 11:10 a.m. Eastern time right here on Yahoo Finance. We're going to get his take on the year ahead with the Fed. This is all part of our 2024 investor guide. Well, shares of U.S. Steel surging this morning after announcing that it will be acquired by Japan's Nippon Steel in a nearly $15 billion deal. Now, this deal is expected to close in the second or third quarter of 2024 after getting unanimous approval from both company boards. You can see the stock reaction right now with shares surging just over 25%. Brad, we have been talking about a potential acquisition of U.S. Steel going back to the middle of the summer. About August, I believe, was when we first heard talk that there was interest from rival Cleveland-Cliffs. Now, much of that focus was surrounding what exactly that would mean for the U.S. steel industry, right? Because if we did see a player come out and a domestic player come out and buy U.S. Steel, that of course then would bring the number of larger players here in the U.S. market from 4 to 3. That is not happening with this deal. So I think that's really the significant part of this. And we're seeing the excitement just about the valuation and how much the deal is valued at reflected in the stock price here this morning. Yeah,
this is in a deal, if it does fully go through, way that the average investor out there can kind of also look at this is a foreign investment into a major U.S. steel company. And now what does that mean for some of where we're seeing the international kind of, handshake agreements, but then also formalized agreements where there's a lack of even being able to sell chips into certain regions right now. And so this could be the wave of M&A that actually proceeds into next year. If you were to see multinational organizations go after specific commodities on a nation by nation basis, and then it be up to regulators to decide, okay, are you going to approve and ultimately let this go through, and have a foreign entity essentially owning what is a major commodity here in the U.S. I think that's the larger question that we have to think about going into 2024 as well. And if that does proceed, exactly how much money could be sloshing around because of the international funds that enter into the M&A environment as well.
Yeah, certainly. When it comes to this deal, again, like we just said there, it's expected to close in either the second or third quarter of next year. And in terms of what this means for production, 86 million tons they see in total annual crude steel capacity looking ahead going forward following this deal.
That's right. We're also tracking this big story that may have impacted you there at home. It's a wet morning for the East Coast as a storm sweeps across states after slamming Florida and the Carolinas over the weekend, leaving flooding and wind alerts in its wake. The storm is expected to leave roughly 6 inches of rain throughout the Northeast before moving north into Canada later today. Thousands of residents in Connecticut, New York, and New Jersey have been left without power this morning. And there you're taking a look at some of the outages. One of the things that I've been taking a look at is some data from FlightAware just regarding some of the U.S. delays here. And of course, this is holistic, not Northeast specific. But as of right now, Monday, we're seeing about 881 U.S. delays, about 382 cancellations. That's actually the high number compared to Friday, Saturday, and Sunday even. So with that in mind, there's still kind of a larger impact that we're seeing from this storm. I was also thinking about FedEx, a company that's going to be reporting earnings this week, and any type of peak season disruptions that they could potentially see. The company may have to acknowledge that on their call when they speak to investors and analysts.
Yeah, exactly. And I think a lot of travelers remember back to 2022 exactly what played out with Southwest because of weather disruptions there leading up to and after the Christmas holiday, leaving millions of customers stranded. So I think people are very aware of these types of risks. And as it is reflected, you just rattled through some of the cancellation and delay notices. What stuck out to me was over the weekend, we did see about 10,000 delays, only about 200 cancellations. So I think airlines are very much prepared for weather disruption following what happened, specifically Southwest. We're going to talk a little bit more about them in just a second here in relation to a fine that they did see because of that. But when it comes to the cancellation aspect, I think many airlines are very prepared. They have their ducks in a row in terms terms of how to mitigate that risk going forward. And that's why I think we're not seeing a bigger reaction of these stocks here ahead of the open. As you can see, we're seeing them just a bit under pressure here ahead of the open in pre-market trading, but we're not seeing significant losses. And I think that is a direct result of the fact that they were able to avoid mass cancellations this time around.
Yeah, the FAA posting yesterday morning, actually, storms may affect travel in parts of the Northeast along the East Coast later today and into Monday here. So we're continuing, based on those numbers that we rattled off earlier, to still see some of those impacts.
Certainly 250,000 people without power, at least of this morning in the Northeast. All right, well, all eyes are on the travel sector as we get closer to that busy holiday weekend. Well, Southwest in particular is in focus as the company faces a record fine following its meltdown last winter that left about 2 million people stranded at airports across the country during the holiday season. For more on this, Yahoo Finance reporter Madison Mills is standing by in the newsroom. Maddie.
Yeah, Shauna, so like you mentioned, this is a $140 million fine, $35 million of that going straight to the federal government. And from the Department of Transportation, this is the biggest fine ever. It's actually 30 times the second highest fine ever. So that just indicates to you, in terms of the context here, just how big this fine is. Now, Southwest did get a little bit of credit from the federal government here because they did give a lot of frequent flyer miles out last holiday season following the impact to these passengers. But again, 2 million passengers impacted. They had 17,000 flights canceled. The CEO saying that this is about some of their infrastructure that needed to be updated. He's saying that they have done what they needed to do to get that infrastructure in place for this holiday season. And the company's credit, he says, they have really improved on these cancellations. They're right about in line with all of the other competing airlines year to date so far, but the stock, not so much. They're down 13% year to date. They were down a little over 2.5% after the close on Friday. This morning, down by just about 0.3% here. So not seeing a ton of movement, but that's in line with the overall market action this morning. But still really having a tough year in comparison with the other airline stocks following just the impact and the fallout of this record-breaking fine. And this also, guys, I should just mention, is part of the federal government's broader push. And we've heard this from Transportation Secretary Pete Buttigieg as well on our very own programs, that he is going to be really looking after the consumer when it comes to the impact of some of these policies from airlines, and really trying to make sure that air travel is set up well for consumers heading into the next couple of years here.
What is that impact on the consumer, Maddie?
Yeah, so this is some good news for folks like me, who, by the way, I have a flight later today that has already gotten delayed 2 hours because of the weather. So keeping my eyes out on that breaking news here, too. But as of May, passengers for Southwest Airlines, they're going to be able to request a voucher of $75 or more if they get to their final destination 3 hours late. Now, I should say lots of stipulations to that. Weather does not impact it, for example. So it's going to be interesting to see to what degree consumers are able to get those vouchers in. But we've seen a lot of airlines offering more vouchers because it's a better move from these companies to offer these vouchers up, as opposed to having this record-breaking fine from the Department of Transportation knocking on your door. So we're continuing to see this as a potential benefit to consumers who are negatively impacted by any air travel delays.
All right, fingers crossed for you in that flight, Maddie, and Godspeed for the length of your journey as well. Appreciate it. Madison Mills up there in the newsroom. Chinese agencies and state firms are ramping up bans of iPhones in the workplace, according to a Bloomberg report. This marks a major escalation from a report in September that a small number had banned the devices, and is a big step in the country's ongoing campaign to wean itself off of foreign devices. China is a major market for Apple. Revenue from the region topped $74 billion last year. And joining us now with more, we've got Yahoo Finance's Inez Ferre. Hey, Inez.
Hey, Brad. Yeah, and this is a big step up in the directive from China, telling its agencies, its state agencies, that their employees basically should leave their foreign devices at home, not to bring foreign devices. Look, this is part of the strategy from China to sort of wean itself off of American technology. This is about data control. It's also about supporting the Chinese brand Huawei, which which makes smartphones and which has been gaining market share in China. But this is a direct blow, seen as a direct blow to Apple's market share in China, and also Samsung and other foreign brands. But China accounted for about 18% of Apple's revenue last year. It's its second largest market. So it's a blow for Apple. And Apple, it's also worth noting, has been shifting its production away from China. So even though as it's its second biggest market, it's also been shifting production away during the pandemic. We saw all these supply chain issues, and it's been shifting to India. So in a way, this is China sort of taking away part of the pie for Apple as Apple is shifting its production from China to India. And India is seen also by analysts as a growing market for China because India uses mostly Android. So it's a market that Apple for Apple. This is a market which Apple can gain market share in. But you have to wonder, part of this is coming as we have seen these sort of icy relationships between China and the US, especially when it comes to data. And again, this production that's been leaving China, going abroad to other places.
Story we are going to continue to track. Nesray, thanks so much for breaking down the latest there for us.
Thank you.
Keep right here on Yahoo Finance. We've got much more of your market action ahead, as well as the opening bell just about 10 minutes from now. We'll be right back.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance. NIO getting a big investment this week. Abu Dhabi-based CYVN Holdings investing $2.2 billion. And once the deal is completed, it'll own about 20% of the EV car maker. This is the first investment in the car maker. They invested over $738 million this past summer. It does come at a time for NIO where investors have been continuing to try and wrap their minds around exactly what production deliveries will look like going forward for a very capital-intensive operation and what margins will ultimately look like, and that kind of base layer that they can anticipate the company will be able to repeatedly deliver. But for a lot of these EV companies, just trying to maintain profitability has been the challenge.
Yeah, exactly. Especially when you take into account the rising competition, exactly how that's playing out through price wars and everything that's going on over and trying to boost adoption of EVs and also have a bigger presence here within that market. But when it comes to NIO sales, yes, they are improving, but they're still very far off of their annual goal, which is 250,000 EVs in 2023. We know that they have been forced to cut back on their staff just a bit because of some of these challenges here that we have been talking about. They trimmed about 10% of their staff. They've also spent around $450 million to purchase production assets from their partners here in order to save in the long term on manufacturing costs. And once again, you're seeing many of these EV players doing everything they can to grow their business at a time when they are trying to put the least amount of pressure on their margins. In many cases, they're not able to do that. We've seen some of these concerns reflected in the stock price of NIO this year, with shares off just about 17% since the start of the year. But really, we have seen a big fall to the downside since their highs earlier this year, just about in August when it was above $15 a share. Here we are today, still below $8 here ahead of the open. All right, let's take a look at Adobe abandoning its $20 billion deal to buy Figma today. Now, this comes after both the UK Competition and Markets Authority and the EU regulators were investigating the deal for competition concerns. Now, in a press release, the tech company is saying that there is, quote, no clear path to receive necessary regulatory approvals from the EU Commission and the UK Competition and Markets Authority. That was the end of the quote there. Regulators saying that the deal could threaten competition in global markets for interactive product design tools. As a termination fee, Adobe is going to be paying Figma $1 billion. Now, this, of course, gets back to the issues that are almost too long to list here up until this point in terms of some of these M&A deals facing regulatory pressure. Lots of worry about competition within this space. And when it comes to this joint statement that we're getting here from both companies, this joint assessment at least, neither of them seeing any real path to gaining that regulatory approval that they would have needed for this deal to go through.
Yeah, the street has hated this since Jump Street. Let's be real. I mean, at the end of the day, this company had announced the acquisition intention for Figma. The shares, they plummeted on the day that they made that announcement. It actually kind of kicked off a very kind of scrutinous deal environment, if scrutinous is a word. Merriam-Webster's don't at me on that one. But at the end of the day, I think it really jump-started a lot of the conversations among investors of what is a good deal, even if companies like Adobe and in this kind of broader landscape where they've got a suite of products, any company similar or analogous to Adobe, what is an actual good deal, even though they've had a history of this acquire to grow in that kind of fabric of their industry. And I think that is exactly what we saw initiate once they announced this deal. I mean, it was about a year ago that they announced this. So all this considered, took us a year just to get to the point where they were saying, okay, this is probably not going to go through, no deal.
Yeah, exactly. But we haven't really seen that weigh on the stock price of Adobe here. When you take a look at the performance that we have seen since the start of the year, at least some of this uncertainty sometimes weighs on the stock price just in terms of what exactly that could mean here. But the stock is up pretty substantially since the start of the year. You're looking at gains of just over 70%. And again, we could see this move to the upside here as we count down to the opening bell following this news. And there is the opening bell as we kick off this holiday trading week ahead of Christmas next week. We are seeing some optimism here at the open. Let's get over to Jared Blickery, who's standing by with a closer look at some of these moves at the open. Jared.
Yes, it's the middle of December. We're still seeing movement here. You don't see that every year. Here we have the Nasdaq leading the day. It's up 35 basis points, about 1%. 1/3 of 1%. Russell 2000 just a little bit more. The Dow treading water, up 7 basis points. Let's take a look at the sector action today. Energy was the biggest gainer early pre-market. It is the biggest gainer now. Crude oil, WTI, up about 2.5%. That is the best performance in a little bit. We'll call it that. Materials up almost 1%. Financial, staple, communication services, and real estate rounding off the top row. But you'll notice not everything, nothing is actually in the red just yet. Although we are seeing XLK, that's the tech sector, kind of tread water here. Well, little oil, PSCE, that is a junior oil ETF. That's up 2.36%, followed by Korean stocks. Then you have regional banks. By the way, regional banks have really come alive. KRE is an ETF that tracks them. Here is a year to date, and you can see just kind of filling this gap that we had from earlier in the year. That would be that March breakdown. We can also take a look at some of the other sectors here. It looks like solar energy is the worst off here, and China not doing that well either. Take a look at Chinese stocks, and we can see Pinduoduo and Alibaba, the two biggest there, down about 1%. JD.com down about 2%. NEO up 5.8%, and it looks like we have an education name, EDU, is a ticker, up 9%. Let's take a look inside the energy sector here, and we can see ExxonMobil is leading the majors up about 1.5%. Actually, Shell is up a bit more. BP up 2%. Conoco up about 1.86%. So some nice moves in the oil patch right there. And here's the banking sector. Looks like kind of a mixed board, not seeing too many outliers. Citigroup up about 1%. Won't call that much. And let's take a look at the travel sector. Haven't checked that out in a little bit, and we can see more red than green here. Booking and Airbnb, those are in the green. So is Expedia, but the cruise lines, Royal Caribbean down about 0.5%, Marriott down 1/3, and then Hyatt down about 0.4%, guys.
Jared, where's the enthusiasm, man? I mean, it's a big day. We had PBA ringing the opening bell.
I wish we had a reaction cam on Brad when this was playing out here at the opening bell. I know.
Huge.
I should have let you jump in there. That's my bad. Not yours, but that's my bad.
Had I known, I would have been down there.
Just a huge Pete Weber energy. Who do you think you are? I am. My gosh. All right, Jared. Good to see you.
I'll be back.
We know.
Always.
Please.
We always count on you there, Jared. All right, well, after the Fed's dovish pivot, everyone is optimistic. At least it seems like that right now. But is there danger that lies ahead? Well, our next guest thinks that thanks to the move, the dollar may weaken and we may see higher commodity prices, including oil. Now, we're starting to see some of that play out a bit. We do see the dollar stabilizing here this morning. Oil prices, though, are off the lows. We have crude back above $73 a barrel. For more on this, we want to bring in Ben Emmons. He's a New Edge Wealth senior portfolio manager. Ben, it's great to see you. So since the last time we spoke, we had this almost, I think it might be a little bit too early to say it's a total pivot, but signs that we could see the Fed pivot next year. How does that then factor into what you see gains looking like in 2024?
Good morning, Jem, and again, keep that enthusiasm, right? Because it's like this year that's starts to gear up for us. Huge year, right? So, I mean, it will be, because I think what Powell did last week was somewhat historic in a way. Like, you really moved ahead of what you are ultimately going to do if inflation goes your way. And so not having that inflation exactly in the path to the Fed just yet, but indicating you're willing to move on rates. Yeah, that does trigger this dollar move, for example, and that is a big deal, because if the dollar sets in motion a broader weakening trend, not only that the boats are in commodities lifted, but so will they be in emerging markets. And I think you're getting then this year where there's going to be relative performance again between the emerging markets potentially having potential to outperform the US. That's extraordinary, given that we're having the Magnificent Seven with all their enthusiasm driving the stock market this year higher, right? So when the magnificent soft landing priced in U.S. markets, that may be seeing that also in emerging markets next year.
Love the enthusiasm, Ben. Where do you think we're going to see rotations in some of that investor enthusiasm next year?
Yeah, I think starts here, Brad, with on the ground. As your colleague just did enthusiastically indicate, Russell 2000 is up and is really gaining some traction. So I think that's where the first rotation happens. In a way, if you think of Magnificent Seven, affecting productivity across the economy, small caps will start to benefit from that as well. But then I think it's the bigger picture of where the emerging markets ultimately play out. Those were markets where the central banks have tightened far more and far earlier than the Fed. And that's, I think, that additional sort of catalyst for upside there. because those central banks are already in an easing path as we speak. So I think that's where the bigger rotation takes place between US and emerging markets.
Ben, when we talk a little bit more about emerging markets, I guess where specifically do you expect to see some of that strength?
I think it's two parts. I mean, on the one hand, it's the Latin American markets there, where monetary policy has been very restrictive, and it actually still is. Inflation rates have come off really sharply. On the other hand, you have Asia, but that's Asia ex-China, because again, there too, the Chinese markets struggle despite all the efforts that the Chinese policymakers are making to try to keep the economy going. Let's not forget, by the way, the major liquidity injection that took place on Friday in China that is yet to be really reverberating through the Chinese markets. So I think the Asian markets are the other part of this emerging market story, where I think there's this opportunity. And it's no longer a reopening story. It's really about coming out of the pandemic and getting more normalized markets in terms of monetary policy affecting markets. Therefore, emerging markets have upside.
Ben, I love in your note, you say cash is in the trash here. Walk us through why cash in the trash in 2024.
Yeah, it feels like that anthem, right? Of like, you have this pivot party, so you throw your cash in the trash and you take your plates out for stocks and bonds. I think the idea here, Brad, is that we still have very high rates on T-bills as an example, right? And that will not change until the Fed actually cuts rates. So there's something about cash that still adds income to your portfolio, but then it does get different once the Fed does start lowering rates, and to an extent follows what the market is priced in. So I'd say the word trash is maybe somewhat like exaggerated, but the idea of that we did put a lot of money into cash this year, as the money market funds indicate. Partly it's uncertainty, partly it's the higher rates, partly it's the belief that rates will stay much higher, and it seems that story has changed. So yeah, putting it in the quote-unquote trash and using it for different opportunities, I think that's the story next year.
But what do you think is the biggest risk as we look ahead to the markets in 2024? Yes, there's a lot to be excited and optimistic about, especially when we talk about rate cuts and maybe even getting multiple ones of those here in 2024. But in terms of what investors should keep an eye on when it comes to maybe what they are not watching right now, some of those challenges, what would you say is the biggest risk in 2024?
I think the two risks developing. One, obviously, is our own U.S. political situation. I mean, we do have still challenges in the House and the Senate about getting Ukraine funding through and that sort of thing. And what that could result into is that the mandatory spending cut of 1% across the board really starts to take effect as of January. That will change then to some extent the impulse that the economy has had from fiscal spending this year. Obviously, we get our presidential election much later in the year that to the run-up, and that could cause a lot of, trepidation and uncertainty among people. But the other angle here is the geopolitical angle, and we cannot forget what's happening currently in the Suez Canal. And these attacks that are happening, that's all indirectly related to what Iran's role is in the war in Gaza. So how that will play out is unknown, right? One thing about this glowing story I've been talking about that could derail to the extent is that we do get an energy price shock driven by developments that we're seeing currently. So I think keep that in the back of the mind in terms of what could happen next year, because it's not indeed, of course, all glowing story. There's always a risk reward here, and I think that's one of those risks. The developments in the Middle East and what happens with our presidential election.
Ben Emmons, New Edge Wealth Senior Portfolio Manager. Ben, thanks for kicking off the trading session and the trading week with us.
Thank you, Brad. Jana, thank you very much for having me.
Good to see you. Windom is telling shareholders to reject a buyout from Choice Hotels today. Choice launched another hostile bid for Windom last week. This is just the latest unsolicited bid by Choice to take over Windom after it rejected several offers just this year. Choice is offering shareholders $85 per share, but Windom saying the deal undervalues its business and holds regulatory risks here. Now, for any of the deal making that comes forward within this industry, it is going to be focused on where in this consumer environment they can bring on more capacity without having to start on new build outs, new projects and break ground, do more construction to try and build out that capacity. And it seems here for a lot of the shareholders, they're going to have to continue to decide, is this a deal that they would like to see ultimately go through? And we'll see if Windom is effective in their communications to shareholders as well.
Yeah, I don't think this is necessarily a huge surprise given the back and forth and what we have heard from executives here over the last couple of weeks as this has all played out. But Windom really making an argument here, at least the board saying that they don't think it's in the best interest for their shareholders, and they do believe that they can deliver better long-term shareholder value in excess of what is being offered here through this deal, the $85 per share in cash and stock that is offered by choice. Of course, the question also is going back to just the whole regulatory aspect of this, what exactly that would mean for competition within this space. That, of course, though, not brought up in this, at least for now, but Windom here refusing to proceed with further discussions when it comes to Choice Hotels. So we, of course, will continue to follow the story as it develops. We also want to take another look here at Apple this morning. The tech giant announcing that it plans to pause sales of its Apple Watch Series 9 and Ultra 2 in the United States. This is according to various reports. Now, the halt will begin on Apple's website December 21st at 3 p.m. Eastern Time and in retail locations after December 24th. This is all according to reports here. Now, we know Apple has been facing this long-running patent dispute here, their battle with Massimo over the Apple Watch. We have the International Trade Commission here seeming to agree, at least for now, with some of the concerns over these patents. They have issued the fact that an order that could ban Apple from importing the Apple Watch here in the U.S. We're seeing shares under a bit of pressure here at the open, off just about 1%. But we know Apple has been trying to diversify its revenue base. We know that they have been building a lot and prioritizing their wearable markets. Exactly. We have seen tremendous amount of growth here there really over the last several years. Taking a look at the last full year revenue in 2022, the wearable home and accessory segment making up about 1/10 of Apple's overall sales then.
Yeah, wearables has absolutely been crushing it when it comes to one of the core kind of growth mechanisms for Apple, as well as services, which is going to perhaps get to a $100 billion run rate annualized within the next couple of years here. But at the end of the day, for wearables, what it does is it makes the ecosystem that much stickier, especially if you're walking around wearing the watch or if you've got the AirPods. And so for Apple, this is a serious consideration that they have to move forward with now. And we'll see ultimately what, if anything, the company says about what it plans to do next year as well.
Yeah, and this is all in relation to the patent dispute with Massimo that's related to the blood oxygen sensing here. So something we've been following here at Yahoo Finance. All right, we'll keep right here on Yahoo Finance. We've got much more of your market action ahead. We'll be right back. Microsoft is betting big on AI, from its partnership with OpenAI to its Azure ecosystem here. And after the tech giant's latest announcement, Copilot, our next guest saying that investors should be taking notice. He's calling shares undervalued for its AI opportunities. We want to bring in Fred Havmeyer. He is at Macquarie's head of AI and software research, joining us now. Fred, it's great to have you here. So you're saying, at least making the case, that you think Microsoft shares are undervalued right now, given the potential that we're seeing from Gen AI and Copilot. So what does that profit potential look like?
Right, and thank you very much for having me on again here. So what we think is that when we're taking a look at the overall generative AI opportunity for Microsoft, we see a number of different avenues through which the company can monetize generative AI. Quite clearly, its Copilot product portfolio is one of them. So when we assess this landscape, we take a look at both the revenue opportunity and the profit potential. And we estimate that by fiscal year 2026, that Microsoft could generate an incremental about 49 cents of EPS per share in our base case of monetization, which includes our base case of uptake of the Copilot product portfolio across Microsoft 365 and also across the GitHub Copilot product portfolio. And within that, we also see an opportunity in our bull case for this to rise towards $2.17 per share of EPS uplift by fiscal 2026. In the eventuality that the uptake exceeds our expectations and that the profitability of generative AI is actually running at the high end of our estimates. So I think ultimately what we find is that we found the opportunity to raise our target price to about $430 based on a DCF analysis. And we're extremely optimistic about the Microsoft's ability to drive profitable growth with its Copilot product portfolio.
What type of pricing power do you also bake into the expectations in the calls here?
We're using the base case here that it's priced at about $30 per user per month for the Microsoft 365 Copilot product portfolio. And looking across the entire GitHub suite of products, we're looking again at just on the individual side that users are paying the typical $10 per user per month. And on the business side, that we're seeing business adoption of GitHub Copilot trending with the base case again here of just about $19 per user per month, not assuming that we see uptake yet of the more premium price enterprise SKU, which the company's recently announced.
Yeah, what do you think the uptake rate then looks like for that when you take a look at some of those longer term fundamentals and longer term expectations? And how do you see this playing out with the rise that we've seen in competition?
I think that Microsoft has such a substantial distribution channel already and is also, with Azure, able to distribute its software in an enterprise capable and ready way. Specifically in this case, actually, meaning that it's able to address enterprise security requirements, data privacy requirements, and so forth, which has been keeping many enterprises on the sideline with some other third-party vendors of generative AI software and solutions, that we think that it is positioned the best in the marketplace to drive uptake of generative AI products and services. And so our uptake rates over time here trend in a direction where you're seeing material but not necessarily massive uptake in our base case of each of these products and services, sticking in around the single digits for Microsoft 365 Copilot, but then trending up into the double digits uptake rate towards 25% for GitHub, where we think that more technical users may be able to pull in this already very well reviewed product into their organizations to solve problems that they're facing day to day.
So how does this also translate into business opportunities or even take away business opportunities for some of the competitor Copilots out there, or kind of prompt and response or prompt and generation tools? We've heard from Salesforce even how they plan to roll out a very similar product, it sounds like.
Yeah, I think big picture, when we look at the marketplace right now with generative AI products and services, we would expect almost every software vendor to develop their own AI strategy, with many likely going down this pathway of offering copilots. That is to say, services that are powered by generative AI that are part of the process of helping to make people more productive. And so we'd expect to see this technology emerging almost everywhere. Now, what we think will actually differentiate companies in this landscape is whether they treat generative AI as a full product and the only standalone product, where, say, some sort of a chatbot, or whether you're doing what Microsoft is doing and you're treating it as a feature that is helping their users of their core products and services. If we look at Microsoft 365, then we're talking the Office suite, and making users of those products more efficient, more effective, and altogether just better users. And we think that if you take the latter stance of using it as a feature to make your existing suite of software more effective and better for the users and improving the experience, we think that you actually have differentiation in the market. If you take the former route of relying on AI to be the entire product, we think there's just less differentiation there. So we'd expect copilots to abound and companies that really treat their software as their guiding North Star. We think they're going to be the most successful in this market.
Does the base case assume that regulators will look at Microsoft's investment into OpenAI and determine that it is not some type of kind of shadow merger, if you will?
Yeah, in our base case here, as we've been publishing recently, we've noted, of course, that Microsoft is consistently under regulatory scrutiny in one level or another. But from our point of view, there is no control mechanism of Microsoft into OpenAI under its present structure, which is that OpenAI is governed by a 501c3 with an independent board where Microsoft has no voting power. So when we look at OpenAI and Microsoft's investment into it, we don't believe that there is regulatory risk here. And if you look more broadly across the landscape of generative AI, we see an abundant landscape of competition here, one that is, in our point of view, not actually impacted by any of Microsoft's investments into this space, but has been very rapidly advancing. I mean, even quite recently, we've seen more competition emerge from the likes of startups such as Mistral, certainly Anthropic and others. It's not a narrow competitive landscape. So we don't assume that there will be regulatory impacts in our base case.
All right, well, Microsoft, a company that has long had more money, more problems, and more solutions at the end of the day, too, that they come up with. Fred Havemeyer, who is the Macquarie Head of AI and Software Research. Great to have you here on the show with us. Appreciate it.
Thank you.
Thanks. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Investors flocked to tech stocks this year. The Magnificent Seven, Amazon, Apple, Alphabet, Nvidia, Meta, Microsoft, and Tesla, we put them all in there, helped the S&P 500 reach new heights in 2023. The index currently up over 20% this year. So who will be among the winners in 2024? Analysts at Bernstein say the top tech names investors should buy in the new year. They're Grab, Broadcom, Uber, Pinduoduo, and Taiwan Semiconductor here. So a few to break down. First and foremost, this is one of the second kind of mentions that we've seen in top picks, top tech names for 2024 of Uber. And as we're continuing to kind of look at some of the reasons, at least for Bernstein, they're calling out the this business still being a growth business, further ability to take share in delivery and ride sharing, but delivery is proving to be sticky, they mentioned, but increasingly profitable. People like convenience, they wrote.
Yeah, this is the second call. We were just talking about JP Morgan also naming Uber as one of its top internet picks here for 2024 when you take into account the rapid adoption of rideshare and exactly what they see driving that business going forward, considering that they seem to be widening their lead against their closest competitor when it comes to Lyft. But what stuck out to me in this report here, at least from the outlook for top picks for 2024, was Broadcom. Because yes, we talk about the usual plays all the time when it comes to NVIDIA. NVIDIA is also one of Bernstein's top picks for 2024. But for Broadcom, and they're making the argument there, as Stacey Raskin, the lead analyst for this team here, saying that it is going to benefit from this robust AI story that bridges the near-term core slowdown as well as the significant growth that could be on the way for VMware. So making the case that Broadcom really has room to move to the upside. Also, they're bullish on NVIDIA. They're saying it's the best way to play AI. Not exactly a massive surprise given the huge run-up that we've seen in NVIDIA's stock, up just around 240% since the start of the year. They have their price target, though, on NVIDIA is $700 a share.
Really?
So we talk about the upside, the upward momentum that they see in terms of some of those future gains, certainly pretty high when you compare it to where we are today, still below $500 a share. All right, we'll keep right here on Yahoo Finance. We've got all your market action ahead. We'll be right back.
Well, more than 20 billion packages are expected to be processed this year alone in the U.S., with most of those parcels delivered to your home by truck. But that could all change next year with precise autonomous drone delivery set to take off. Yes, we are talking about your next meal or your prescriptions delivered from the sky. It's all happening thanks to easing regulation and new technology, with a growing list of restaurants and healthcare companies looking to jump in. And there's that's at the forefront on-demand drone delivery. Autonomous drone delivery could finally be coming to your front door. New technology and shifting regulations are shaking up an industry that processes 21 billion a year.
Turn any window.
The first without a all of this in a your food and medicine at a lower cost and faster pace.
I'm Akiko Fujita here in Half Moon Bay, California, and this is what's next in drone deliveries.
Launching zipline 604 in 3, 2, 1. Go ahead and push the button.
Wow! 45 minutes outside of San Francisco, Zipline co-founder Keller Ronaldo Clifton is taking drone delivery from this
Actually backspinning the propeller. There's a delivery.
to this. Zipline's latest drone, known as Platform 2, never actually touches the ground. It hovers 300 feet above in near silence. The droid inside makes the drop to secure delivery.
We're lowering this, we call the droid. The droid is what's controlling its position in an X and Y axis, and then delivering in a very, very precise, gentle, and silent way directly to a customer's home. This is 24 donuts that we can actually load here if you like.
That's quite the order.
Yeah, so why don't you do two of them and I'll do two, but you can fit them in there. Exactly.
Just close it on.
And we can close this. Exactly. You click a button on an iPad and it's automatically shipped.
It's a vision the world first heard about from Jeff Bezos.
These are effectively drones, but there's no reason that they can't be used as delivery vehicles.
Zipline first began drone deliveries in 2016, building a vast network for medical supplies in Rwanda. Today, they're delivering one package every 70 seconds.
Launching zipline 1, 2, 3, 3, 2, 1.
Now the company's making history. In November, Zipline became the first aircraft to fly beyond the visual line of sight autonomously. It came after the FAA granted Zipline and 3 other firms a rare exemption, removing a long-standing rule that required drones to operate within sight of drone operators.
I think for commercial drone deliveries, it's really everything. If you want to have lots of deliveries and really make a business out of this, how many operators are you going to try to have chasing drones around here and there? So it really is kind of the tipping point for this market to be able to develop.
In fact, labor makes up roughly 95% of existing drone delivery costs. Take out human observers, and McKinsey says you've got a reliable and cheaper alternative to standard delivery vans.
Having an automated system that can deliver those things in a way that is 10 times as fast and half the cost is going to seem so incredibly obvious.
So I'm thinking about what is available to customers today. You've already got same-day delivery. You've got a DoorDash, Grubhub, any food delivery within an hour.
Within an hour, exactly.
What does this give us?
So this gives you really within 5 or 10 minutes. We call it instant delivery today, but an hour is actually pretty slow. You kind of see the inevitable march, right? This idea of using a human driving a 3,000 to 4,000 pound gas combustion vehicle to deliver something that weighs 5 pounds, it will seem crazy that we solve the problem in that way. It will be very, very obvious to people that this is a problem that requires a level of scale and automation and zero emission technology that can only really be executed like this.
Zipline's new system doesn't require a warehouse to launch the drones. Each docking station can be built into any business,
so it's customized for each company.
We can install the technology onto any wall. So whether it is a retail store or a hospital or primary care facility or even a restaurant, in 24 hours we can show up, install the infrastructure, and then you turn any window or hole in the wall into a magical portal. This is a prototype version. This is a tester of the dock. So this black dock you see there is what the actual Zip can dock into and out of when it's picking up a delivery.
That's intended to make adoption seamless. Each aircraft can travel within a 10-mile radius and carry up to 8 pounds, the equivalent of 2 medium pizzas and a soda. The company has already signed nearly a dozen partnerships, with deliveries set to land in 2024.
So you could compare this to something like an autonomous vehicle that's on the road today, but we fly through the air.
Zipline faces plenty of competition, with Amazon's Prime Air and Alphabet's Wing attempting precise on-demand delivery. There's also a handful of other startups looking to race ahead with renewed interest from venture capital. It's here inside Zipline's factory where we get a glimpse of just how the company hones its craft.
This whole system is designed in a modular fashion. This is something that really helps us ensure that we are able to have an incredibly high reliability service. This is testing a very key part of our next generation system. This wire has to be able to descend 100 meters and carry the weight of the smaller aircraft plus the payload that's inside of it all the way down and all the way up. Yes.
I've heard the company say many times that you're looking for dinner plate precision.
Yes.
Why is that important?
There are many different sources of obstacles in backyards. What we're aiming for is plus minus half-meter accuracy. And what that means is that anyone who has even a narrow walkway leading up to their house has a place that we can deliver to.
The mics attached to the wing are key to safety. They serve as listening devices for any interference in the air.
What do you use this tight space for?
Yeah, so we are inside of a wind tunnel. We've been developing this microphone technology that allows us to listen for other aircraft and avoid them.
That's critical because air traffic control doesn't have the network and technology to track drones in real time yet. Zipline manages their own fleet. The company plans to introduce its drone technology to as many as 15 cities in the U.S. by 2025. By 2026, Zipline hopes to expand across the country.
We're just at the beginning. I mean, you're seeing, it's 12:01 a.m. when it comes to this kind of technology. We will look back in 10 years, and I'm sure, so much of this, it will seem, mind-blowing given how far the technology has evolved.
Now, to be clear, drone deliveries have been happening globally. McKinsey data points to roughly 875,000 to 900,000 packages being delivered by drone globally. But this technology, guys, to be very clear, takes it on a whole nother level. The way Zipline describes it is in their first generation drone, Platform 1, that needed space of roughly 2 parking spots to be able to deliver a package by parachute. This new technology you saw, as he describes it, the CEO described it, points to dinner plate precision. So I don't know if you're up for it. Your next DoorDash delivery straight on your doorstep.
I'm up for it because it sounds so convenient, right? I would love to know the people that are pushing back on this. And Akiko, the highlight for me of that package was when you hit that button for the drone launch. I was nervous even just watching you do it. But it's not just about, you bring up, I think a lot of people bring up safety and just the accuracy of this, exactly what the FAA is able to do and not do when it comes to tracking. Where does that stand?
Yeah, so regulation, as we pointed out, is still very much shifting. If you think about air traffic control right now, the radar there was set up to specifically track for flights that are at a certain altitude or higher. Drones don't necessarily land on that radar because they fly at a lower altitude. In some drone cases, it's because they're a little smaller. And so there for individual companies to management system. Zipline, as Keller Renato Clifton there described, has their own software system. Other companies are partnering with other firms that are managing these software systems, but that's going to be changing very quickly as well. We did speak with the FAA by email. They specifically said they are looking at developing standard rules to make what we described as the beyond visual line of sight. So you don't necessarily have to have a human
observer continue to track for most drones. They're trying to change that so they can scale this and then make it more economically viable. But as we pointed out in the piece, Zipline's already got that exception in place, and they are set to really take off in a big way in 2024.
All right, really fascinating piece there. Thanks so much, Akiko, for pressing the button, number one. Somebody made sure they got their package out there.
Who knew drones had so much force, right? That was my takeaway.
My goodness, it came out the blocks really strong there. All right, thanks so much, Akiko. We appreciate it. Everyone, we've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. It's the last full week of the year, and investors have a few more big data points to watch before the holidays. Joining us now with what we should be paying close attention to this week, we've got Yahoo Finance reporter Josh Schaefer. Josh, how excited should we be on this pre-cheer week?
Always excited, Brad.
Always excited.
Stocks are near all-time highs. Got to be excited, right? Got to be excited.
And we got till Christmas.
And we got some earnings to run through this
Holiday
week, right?
cheermeister, yes.
There's plenty to cover this week, which keeps us excited when you take a look at that earnings calendar, right? Several big companies reporting earnings ahead of that holiday shortened week next week. So you see there, you got FedEx tomorrow, General Mills, Nike, Carnival. And sort of my big takeaway here when you zoom out and think about all of those companies, it's another look at the consumer, right? And specifically when you think about Nike and when that quarter ends, we're going to get Nike's report through the end of November. So we're going to get part of those holiday sales, right? We're going to understand sort of how Nike started the holiday season and then also get their outlook for what they expect overall through the holiday season. Analysts projecting through that right now think they are going to see a little bit slower demand in North America. So it will just be interesting, I think, overall to start to understand the holiday picture. And if people like Brad kept buying Jordans for Christmas. Right?
Always.
I got one of them, yeah.
They're expensive.
I mean,
You're doing your weekly checks at Foot Locker.
I mean, it's great when you see that sneakers, you know, the got 'em thing come up after you finally hit on a pair after missing for like, I don't know, taking 1,200 L's out here.
We know. With inflation, maybe it might. But when it comes to headwind, right? Maybe on it on
right, faster than, and the Fed welcome sign, right? So do we see that Friday? And really what we're looking for on Friday CE report, we're looking at core volatile categories of food and energy, right? On your screen there, we're expecting month-over-month increase in core year over year. And it just sort of some of the other things we're tracking in the some big market rally if inflation comes in, numbers, but we're now getting to people are expecting inflation to fall in this nice path, right? So you come in line for us to meet the expectations. Expectations have been getting a little bit harder to meet.
Yeah, when we were talking to strategists at the T500 target for the S&P year-end 2024, talking about the optimism that's playing out. So we could either meet those expectations or on the flip side be a big disappointment if we do see a hotter than expected print rate. Josh, thanks.
5,500 holiday share.
I know, a lot of holiday shares, especially for 2024 when we eventually get there, right? Well, let's talk about one of those big things, big moments, big reports that Josh was just talking about, and that is FedEx. We're going to hear from FedEx tomorrow. They're going to give us some insight into the consumer. As it looks to gain rivals, the stock now trading at the highest level that we've seen in just about a year. You can see it pushing further to the upside here this morning, just around 283 a share. But Brad, when it comes to, I know you're closely out following these earnings, what we could hear from FedEx tomorrow, but their margins are expected to be a bit stronger. We know that Yellow's bankruptcy happening earlier this year could provide a little bit of boost here in the medium term. But again, this is really going to be a great reading on the consumer and what exactly those volume levels look like.
Yeah, they mentioned Yellow and that bankruptcy in the previous quarter, talking about the labor negotiations, how that played out, the primary competitor, and ultimately the broader market and industry. And so that's where they kind of encapsulated some of the Yellow conversation. But really, the core priorities, 3 priorities that they continue to talk about: protecting customers, delivering outstanding service, focusing on high quality revenue. The service delivery is going to be tough. We were talking about weather outside and how that could potentially come up on the earnings call. That is one area that we're going to be listening for. And this is their peak season. This is an extremely important season for FedEx. They cannot stress this enough. We cannot stress this enough in talking about this. And so any insight that they give about how customers are continuing to take on more product in this season, and then layer on the fact that this peak season is also coming with higher costs as well. That is something that's baked into this peak season that they talked about in the most recent quarter. And so we'll get more of an update tomorrow from FedEx on how they're seeing the consumer, as well as some of those B2B customers that they work with as well that are taking on costs. Also, the weather outside may be frightful, but for some commodities futures, soft commodities futures, it has been pretty delightful. Coffee, cocoa, orange juice, OJ, they have soared more than any other raw materials in 2023, with orange juice leading the charge, hitting a record high in November, up over 90%. Here to break down the business of sips, we've got our very own Jared Blickery. Hey, Jared.
Hey, Brad, I love this time of year because we get to talk about things. I don't talk about frozen concentrate orange juice enough, but you can see up 93.6% this year. If I superimpose this, we'll have to do this mentally on my leaderboard here. You can see not quite up to Bitcoin. That's up 150% year to date, and not quite up to the New York FANG index, and that includes a Magnificent 7 for the most part, but it is greater than ARK, and a 64% for that security for that ETF is pretty sizable. But as you mentioned, orange juice is a soft, and we don't talk about those a lot. It's a classic commodities, kind of a catch-all that includes coffee, as well as some others here. Cocoa, for instance, cocoa up 66.7%. And these are assets that investors can buy through ETFs that are generally uncorrelated to the rest of the market. I can show you a chart of OJ here. It's not going to have that much correlation to 10-year T-note yield. It is going to be influenced by the dollar, but guess what? The dollar has been relatively trendless this year. I think the US dollar index is down only mildly from the start of the year, so hasn't been too much of a force here. And you can see orange juice coming off record highs here. The impetus, well, as it often is the case with commodities, it is weather related as well as disease. And for that matter, those are the same reasons that we are seeing cocoa at elevated and record prices as well. You can see up 66%, although although a different part of the world and different diseases, different weather patterns, the story is somewhat the same there. And just kind of rounding out the top row, we have feeder cattle, that's up 22%, coffee up 14%, gold, remember gold, that's up 10%. That gets a lot of headlines, as well as sugar. There's another soft that's up 9%. And by the way, lumber, that is up 5% as well. But I think one of the bigger surprises this year is that we did not see more action in the commodities. There was all kinds of expectation with China, the reopening at the beginning of the year, and the demand that that was supposed to cause. Well, that did not really occur. And we can see the S&P GSCI index, that is pretty much toward the lows of the year there. And what I think is interesting, if we take a 5-year view, we can see this spike here. This was actually due to the Russian invasion of Ukraine, but we've been relatively trendless for most of the year. So not a whole lot acting there, although in individual issues, I think you could make the argument quite well that we did see a lot of action. Here's crude oil. I'm just going to chart that real quickly. I don't think a lot of people expected that we'd be 8-10 weeks into a downtrend right here, touching the high 60s, but nevertheless, here we are. Back to the main point there, orange juice. 93%, guys.
Massive run up in orange juice. All right, Jared, thanks so much for breaking that down for us. Well, let's talk a little bit more about inflation, and this time versus the market gains. What is driving the high-end shopper this holiday season? Well, recent credit card data from Citi and Barclays both showing that higher prices and uncertainty may be taking a toll this year. Spending on luxury goods falling in November and October from their levels a year ago. So how's this holiday shopping season shaping up? For that, we want to bring in Mark Metrick. He is Saks CEO, along with our very own Brian Asazi. Great to have both of you. Mark, let's start with what you are seeing this holiday season. How is the very important few weeks here leading up to Christmas shaping up so far?
Look, it was a challenging period coming in. And, we put some research out into the field. We do it quarterly with the luxury consumer. And look, 75% of luxury consumers indicated that they were going to spend the same, if not more, this holiday period. And, we're seeing that. Okay, so we're seeing our average unit retails are up. Our average order values are up. Some of that is driven by price. Some of that is driven strategically. So that's the good side. On the other side of it, you've got 25% of folks that indicated they were going to spend less. And they are, and we're seeing that manifest in the numbers. So I would couch this as challenging. This holiday period has been challenging, just like the trend of the business was coming in.
Mark, Brian here. Good to see you. Are you surprised by some of these challenges you are seeing in certain categories? Look, the stock market's at a record. Theoretically, that should be good for businesses like yours.
Yeah, look, I think we're a sentiment-based business, and the same research we did, the luxury consumer never got overly concerned with their own financial position. So, that's not been sort of a big headwind. It also takes a little bit of time for the positivity that's in the market to move its way through to the consumer. So it's not as minute by minute as some folks might think.
On a category basis, within some of the luxury purchases, have you seen maybe not a trade down, but a trade off of specific types of SKUs?
No, I think what you're seeing are people might be buying one instead of two, or they might not be buying, but you're not seeing a trade down. Luxury is permanent. Luxury is here to stay. People are not going to trade down out of it. Folks that reached in maybe a few years ago, even last year, might not be reaching in this year. But the core luxury consumer doesn't trade down.
Mark, I'm not going to give you any guff for that. I guess that Zach Wilson jersey behind you. We'll take that offline. I think I still have your email address. But what categories?
It's a Garrett Wilson jersey, Brian.
Okay, all right, fine. All right, we'll take it offline. Just playing what Brad just said, what categories are outperforming? Is it shoes? Is it jewelry? Where are you seeing the biggest sales growth?
Yeah, what's interesting is, this period of time, all the folks that took this survey, 50% of their spend was going to be self-purchase, right? So you're seeing a lot. We're a go out and travel business. So you're continuing to see that. You're seeing suiting, you're seeing evening dresses, you're seeing all that sort of cold weather footwear. So boots and booties, that's moving well. Outerwear, which has had sort of an unprecedented run. It's been 3 or 4 years in a row. I don't know how many coats people can own, but they're still going there. So you're still seeing that win. And then for the gifting side, it's the beauty advent calendar. We love it. We make fun of it, but we sold out of it already. And it's something that's exciting, and it kind of talks to the holidays. And you're seeing gold and diamond jewelry, which is something that we're actually amplifying at Saks, work really well. So, it's been a good story on the luxury side for categories. Nothing's really fallen off a cliff. And that's what we like to see, a good balance.
So Mark, what does all this then tell us about 2024, how you're planning, where you're expecting to see some strength as we look ahead to the next 12 to 24 months?
Yeah, look, I think it's always important for me to mention, we at Sachs, we see luxury as a long game. Luxury is here to stay. You can't move your strategy or pivot too hard just based on the near-term outlook. Okay, so that being said, we have to be deliberate and very careful as we approach 24. And I'm calling it a year of progress at Sachs. But if I would have to couch it, it's going to be a year of two halves. Okay, I see the first year, the first half of the year, nothing's going to spark the consumer. Nothing's going to get them excited. This starts in a few weeks, right? So I think the first half of the year is going to be a little tougher. And then as you move into the second half of the year, you're going to get, some of this positivity in the market. Hopefully it stays. It's going to move its way through to the consumer. There's all this talk of rate cuts in the second half. That's a boon for the consumer. And then, of course, you have an election. Now, that can be a distraction, but it's certainly going to bring they're going to want some escapism. They're going to want to do something for themselves. So that could be something positive for the luxury consumer. So the second half, I'm seeing to be a bit better than the first.
When you think about the brands that you sell within your store footprints and online as well, and all those relationships with customers coming to Sachs, looking for some of those high value, high cost brands as well, do you believe that we're going to see any more M&A activity within some of those brands?
I try not to focus too much on that. What I want is to execute our strategy the right way, to get Sachs out in front of it. Whatever happens with our brand partners happens. But I remain very committed to what we're doing here, and that's what we're focused on.
Zach, how are you looking at the prospects here with Neiman Marcus, how you see that fitting into the roadmap here down the road? And when you take into account some of the troubles that maybe some of the other luxury brands have had, what do you attribute that to, just given your experience and years that you have obviously had in the field?
I missed the question a little bit. I heard Neiman Marcus, so I'm not sure.
Yeah, just in terms of the trouble that we have seen play out with other brands within the retail space. When it comes to the success of Sachs, what do you attribute that to? And I guess in terms of what you have learned throughout your career, how that's then shaping your planning, given the fact that you go back to what you've said a couple of times here, with luxury being a long-term play.
And I think, look, that's what really is going to separate the folks that are very successful from the folks that might not be as successful. And that's what we did during the pandemic. And that's what we're going to do now. It's about staying committed to your strategy. And obviously you got to manage through the near term, but it's staying committed. And that's one of the lessons I learned at Sachs. You can't pivot for the near term. You've got to move forward and you got to drive through it. And you got to do it smart, but you got to stay very, very focused.
Mark, are you still in active talks with the folks at Neiman on a transaction?
You got to read that in the paper. I'm not sure. Right now I'm in active talks with just driving my business and focusing on that. And I'm gonna let all those rumors be all those rumors.
Do you think in the same boat, you have to be seeing what's happening over at Macy's, and there's reports today that Sycamore might be making a play. Do you view Macy's as a distracted competitor as it looks to potentially go through a process like that?
No, I think, look, I try to focus on Sachs and what we're doing, and I think the guys at Macy's know how to run their business, and I don't think it's going to be that type of play. But again, for Sachs, we want a stable retail environment. We want folks to be focused. We want everyone to be moving for the consumer, and that's what I'm hoping for next year.
What would check the boxes for you, Mark, as an additive element that another business, if you were looking at any type of acquisitions in 2024, should and could bring to Sachs?
Again, it's a matter of fit. It's a matter of, making sure that it's not going to be too much of something that you need to digest. But I'm not doing a lot of thinking about, absorbing or combining or doing that kind of work. Again, it's about the strategy. It's about doing what we need to do. And we got to work through that. That's, priority 1, 2, and 3.
Mark Metrick, who is the Sachs CEO and Yahoo Finance's executive editor, Brian Sozzi, joining us here for the conversation. Thanks so much for the time this morning.
Thanks. Happy holidays, guys. Brian, call me later.
I appreciate it. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Crude oil has been on a roller coaster ride this year. There have been no shortage of catalysts, from Fed policy to inventory levels and, of course, geopolitical risks. Our next guest thinks the oil market is facing a tug of war. On one side, geopolitics and production cuts. On the other, shrinking demand out of China and record production out of the U.S. Scott Bauer, Prosper Trading CEO, here to tell us more. So, Scott, perhaps we start there.
Yes.
Who is winning the game of tug of war right now?
That's a toss-up. It really is. I do think that down the road, barring any escalation of geopolitical events, which is always, impossible to predict, I do think oil ticks lower. I think we're going to see a 6 handle sooner rather than later, again, barring any sort of geopolitical event. But, you really do have so many factors on both sides of the aisle here, right? You've got the geopolitics. The most recent is what's going on out with all of the shipping containers pretty much being halted right now. So that's number one. You've got Russia deepening their cuts. Now, I'm not so sure how much that affects the marketplace, because I think a lot of that is factored in. But you also have, OPEC cuts. And then on the other side now, you've got the demand destruction, and I call it destruction, out of China, and record production right here in the U.S. So it is really, this give and take. But I do think the fact that this demand destruction coupled with our record production wins out in the end, barring any sort of geopolitical escalation.
So, Scott, we could see more pressure here on crude prices, saying a 6 handle here at some point. Are we going to stay at that level, or taking a look maybe with a longer term view? How do you see some of the factors if we do see this return demand, or obviously the million-dollar question just in terms of a escalating conflict here in the Middle East or elsewhere, how that could then eventually drive prices higher?
Yeah, so I really believe that if there's an escalation, the geopolitical premium, if you will, is probably $5 to $10 a barrel. So I would look at, 78 to 80, let's call it, being an absolute top. But I don't think we get back there again unless there's something that happens. I do think longer run here, we see this 6 handle until something starts to shift out of China. Because again, we are producing more and more and more out of the Permian. That's why you're seeing companies, in these big transactions, like what IXIC did last week. Not only are they producing more, but they're getting more efficient. They're doing it with less rigs. So the efficiency at what they are producing is at record levels as well. So to me, everything is pointing to a lower price per barrel here. Obviously, you also have the weakening dollar, which has helped commodity prices, because we know the dynamic there. So big tug of war, but I really believe the trajectory is on the downside.
Well, the acquisitions that we've seen over the course of this year, will they be net positive for that price per barrel?
I think they will actually wind up being net negative because of the efficiencies. But as I was reading through and really understanding the IXIC transaction, they look at longer term a sustained profitability around $50 a barrel. That's kind of their benchmark. That's a long way down from where we are right now. So I actually think that this is going to be net negative for the price of oil, but they're going to be able to produce more efficiently. Their margins may actually get better.
Scott, we certainly have seen an uptick in M&A when it comes to the energy sector here over the last several weeks. Looking ahead, though, to what that future consolidation will look like and ultimately how that's going to impact the price of crude down the line. What do you see there?
I think we're going to continue. The big players in the marketplace, the Chevrons, the Exxons, Oxy, they're doing this because they know that the competition is getting smaller and smaller and smaller, and they need a piece of it. And they really see that the Permian and production here in the U.S., they see the efficiency of it. Now, are they getting to a top perhaps? Are we at maximum capacity in terms of production? We're probably getting there. But I think we're going to see more and more consolidation because some of the smaller players in the marketplace look at this also and say, boy, if we don't get ourselves out there, if we don't make a move and, maybe get acquired by some of the bigger guys in the marketplace here, we may be left out in the cold.
Are the days of oil having a profound impact on the inflationary picture behind us?
Temporarily, yes. Unless inflation starts to rear its ugly head again, if we start to see some really bad prints, if PCE starts to go up, not just with the report we get later this week, but month over month, then yes, that can happen. But that seeing gasoline prices now at a national level of almost under $3 a gallon, compared to where we were at $4.5 a gallon just a year ago, boy, that's a huge amount of inflationary pressure that's off. I can't say we're not going to get there again, but imminently or within the next few quarters, yeah, I don't see that at all. And I do think that helps ease that inflation worry.
All right, Scott Bauer, always great to get your insight. Thanks so much for joining us here this morning. Prosper Trading Academy CEO.
Thank you guys
Thanks
very much.
Well, the EU is investigating Elon Musk's X, formerly known as Twitter, while the bloc's regulator is probing the social media platform for its suspected failure to counter illicit content and disinformation, a lack of advertising transparency, and what it calls a suspected deceptive design of the user interface. It's the first move in the EU's landmark Digital Services Act. For more on this, we want to bring in Yahoo Finance's very own Rick Newman. And Rick, of course, we know that the EU has been really the aggressor or taking lead in a lot of these types of investigations. But what does it mean here for the U.S. and what we could see play out within the United States?
Yeah, it's interesting because Europe does have stricter rules for social media platforms and online web services companies in general. So what the EU seems to be saying here is they have done what they call a preliminary investigation into X, formerly known as Twitter. And they have found some problems. And anybody who uses Twitter knows you don't have to look very far or peck around very much before you find whether it's bogus content, people posting propaganda, disinformation, even deep fakes and things like that. And Europe has the laws in place to actually enforce that. And the part they're calling deceptive, that is their word, is the blue check mark, that the so-called verification, which of course Elon Musk changed when he bought the company. Anybody can get the blue check mark as long as you pay the monthly fee for it. And what X says, and what Elon Musk himself has actually tweeted on there, he says, well, that basically when we give the blue check mark, we verify that these accounts do not have the characteristics of bot accounts or fake accounts. But that's it. Anybody can get it. You just have to pay for it and then meet those guidelines. So what the EU is going to do is they're going to do an investigation. They're going to find something. That seems pretty certain. And then the question is, what happens after that? I don't think they'll try to shut down X, but they can fine the company. And the law says they can fine it for up to 6% of its annual revenue. Given that X seems to be in pretty bad shape right now, that would be sizable. So there's a lot to look forward here. In terms of anything like this that's going to happen in the United States, I don't know. I mean, Congress is always talking about trying to do something to rein in social media or do something, and it just doesn't get very far. So I think Europe is going to stay in the lead on this.
Rick, thanks so much for tracking this, breaking this down for us. Yahoo Finance's own Rick Newman. Appreciate it.
Hi, guys.
See ya. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. As consumers look to fill up their carts, gas tanks, and closets this year, a rising number of Americans leaned on alternative payments like buy now, pay later. According to Adobe Analytics, for the first 11 months of the year, from January 1st to December 6th, consumers spent a total of $64.9 billion using buy now, pay later platforms. That's up 15% from a year ago, and this is leading to the perfect storm for both fintech companies and retailers. Brooke DePalma is here with the details. Hey, Brooke.
Good morning, Brad. Good morning, Sean. I mean, certainly we've seen so many consumers be resilient this year, a very cautiously optimistic consumer spending, even though their wallets have remained pinched all year. But these alternate payment options like buy now, pay later, really rising to the occasion, really allowing consumers to break down and split up their payments into equal installments. And even a firm CEO coming on to Yahoo Finance touting that consumers see this as a safer option with closed and fixed loans and avoid the traps of revolving credit without any late fees. So what exactly does this mean for the economy? Well, economists telling me that it's allowed consumers to have an easier time spending than historically, and this has allowed for more spending, increased sales, and greater financial inclusion. And it's also been a win for retailers because if these consumers didn't have this option and they didn't want to rely on credit, well, then they ultimately wouldn't have made as many sales as they have so far this year. Retailers, one expert telling me that this was a good deal for retailers so far this year. But it's important to know that we have limited data on these buy now, pay later companies. We know that according to the Consumer Financial Protection Bureau report back in March, that consumers using these services tend to have a household income between $20,000 to $50,000, which one expert telling me that's a very more vulnerable population. So it's important to keep an eye on this come 2024. If households rely on these buy now, pay later options, well, then all these small payments could ultimately lead to a larger balance that could lead to vulnerability. So one expert telling me that it's important for consumers to really take a look at themselves and ask, if I have an unexpected payment, can I still afford to pay this off? Yeah, and Brooke, we know what this means from a consumer standpoint, but what about from an investor standpoint? Because I think a lot of people are out there trying to figure out exactly what this means if they are able to profit off this type of trend. What stocks would you say are best positioned in the category? Yeah, well, many analysts telling me that Affirm is a clear winner in the pack here. Affirm, PayPal, Square, which owns Afterpay, they're all down from their IPO price, but Affirm really seeing an uptick. Year to date, shares are up more than 340%. And in the last month alone, shares of Affirm are up 70%. But really the way that it works is Affirm earns revenue partially from merchants when they help facilitate a transaction. They dub it merchant discount rate. So essentially if a consumer buys $100 pairs of shoes, then Affirm pays the retailer $95 and Affirm makes $5. And one expert telling me said that they're the leader of the pack with the greatest ability to underwrite for these purchases, and Affirm is continuously assessing customers' financial health after each purchase. He also said that come years from now, buy now, pay later will just be one way that Affirm makes money. And so the idea that they're able to skirt around the risk that consumers won't be able to pay back is a key component of Affirm's business model. But there are currently ratings of 5 buys, 11 holds, and 6 sells of Affirm on the street right now. Some of the risks outlined is that we saw that boom of e-commerce during the pandemic. Can they keep up with that as they look to make their way in physical retailers as well? And also the competition just keeps rising as PayPal and Afterpay really look to get a slice of this pie.
Crazy year-to-date performance that we've seen for Affirm, and of course it comes off of some of the company lows, but at the same time still remarkable environment that they're navigating through right now.
Yeah, still down from their IPO though, so
exactly.
People look out, yeah.
Our own Brooke DePalma breaking down all things BNPL here this holiday season. Thanks so much, Brooke. Well, Airbnb-friendly apartments turns 1 today. The marketplace run by Airbnb gives renters access to buildings that will allow them to rent out their space part-time. The program has more than 400 buildings in its inventory, operating across 17 states, but with mortgage rates falling and several rate cuts anticipated in 2024, what's the program's growth look like for the year ahead? We're joined by Jesse Stein, who is the Airbnb Global Head of Real Estate, and Yahoo Finance's Danny Romero. Great to have you here for this conversation. Danny and Jesse, we got to just jump off with how Airbnb has been able to do with this particular offering for the first year that you've seen. What kind of contribution to revenue has it also shown to the company?
Yeah, well, thanks for having me, guys. Really appreciate it. Airbnb, we hit our anniversary this year of Airbnb-friendly apartments. Started with 175 apartments in roughly 25 cities, and now we're over 400 apartments in roughly 40 markets around the U.S. And it's been really, really well received by the landlord community as well as the renters. To date, we've had roughly 900 renters host their homes, and they've made over $7 million. On average, the average renter has made roughly $3,500 through the first year of the program, and we're adding new markets and new buildings every week.
Jesse, what have been the biggest surprises since rolling out this program?
You know, the biggest surprise, honestly, has been the reception from the institutional real estate community. They love the program. They love the opportunity. They love the model. Consumers are looking for more flexibility. Consumers are looking for ways to keep up with the cost of living. And the response from the institutional real estate community has been, exceeded our expectations. And renters are now looking for apartments in which allow them to host part-time. So on both sides of the marketplace, we've been very, very blessed.
And Jesse, there's also a surplus of supply in the rental market, and even some markets are dealing with some saturation. How is Airbnb's program able to compete in those markets?
Well, I think there's so much supply hitting the market today, especially in the Sun Belt of the U.S. And this offering really differentiates your building from other buildings around you. So it attracts new consumers. Consumers want the flexibility. Consumers want the ability to make extra income. So we are scaling very, very well across the U.S., but especially in the Sun Belt, where there is a tremendous amount of supply that's going to hit the market over the next 12 to 18 months.
For the number of apartments that you've been able to contract with to this point, I imagine that there's some type of revenue sharing that might even have to take place. What is the kind of comparison when you think about the profitability, the margin versus a typical listing that would go up on Airbnb?
Yeah, I would think about it differently. To a certain degree, this is one's primary home, and they are not looking to arbitrage their unfurnished rent. They are looking to simply monetize their space when they are traveling for work, for pleasure, for whatever. So the average host has made $3,500, but that obviously is the average. In some markets, it's dramatically higher. In other markets, it's a little bit lower. It all depends on demand in that market and the use pattern of that resident. Some consumers are hosting 60 nights a year. Some are hosting 6 nights a year. So it really depends on the consumer's profile. The integrity of the program is to monetize your space when you're not there. It is definitely not to take away the housing stock and run a dedicated hotel, if you will.
And more states are regulating short-term rentals. For example, New York City has definitely made that push towards that direction. How are you factoring those conditions when thinking about expanding this program?
Yeah, well, let me touch on New York. First and foremost, New York is an outlier. If you look at New York, it is basically a de facto ban on Airbnb. Other major markets in the US, let's take LA and San Francisco, allow individuals to do unhosted stays, meaning you can host your apartment when you're traveling part-time. So New York is an outlier. And unfortunately, Airbnb Friendly is not in New York City at the moment. But if it was in New York City, individuals would be allowed to host their homes part-time. So we work across the US and we work with whatever the regulations are, and our partners vet those regulations before they roll out the program.
In the first year that this has been online, have you seen this change the affordability scale in some of the regions?
Yeah, 100%. I mean, at the end of the day, affordability is your income in whatever rent may be. This helps individuals increase their income levels by hosting part-time. So it does help affordability. It does put incremental money in people's pockets. An extra $300 a month is a lot of money for a lot of individuals. So it has been very, very helpful for a tremendous amount of folks. And we've seen people be able to stay in their homes because they are now allowed to host part-time.
All right. Jesse Stein and Danny Romero here joining us for the conversation. Thanks so much. We appreciate it.
Thank you, guys.
Thanks. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Both.
A tale of two coasts. Stay tuned for our 11 a.m. hour all week, where Akiko Fujita and Rochelle Okufo are bringing you key stories from the East and the West, kicking off today with the state of the economy. You do not want to miss that.
We certainly won't, and I know we're going to be doing this as a week-long special, so we will be digging into many aspects of the Tale of Two Coasts and what Americans are seeing on the two coasts that are a little bit different here in terms of cross industries. Let's take a look at the markets here about an hour and a half into the trading day. We're looking at some gains, at least for the S&P and the Nasdaq, continuing that bull run that we have been closely tracking over the last 7 weeks. You're seeing some pressure on the Dow, with the Dow starting the week off just below the flat line. We do have a slew of earnings that are on tap ahead of the holiday shortened week next week, as well as a number of important economic prints that will be released Friday. We will get that PCE report. We know that's the Fed's preferred inflation gauge. So any hot print there, or the fact that maybe they didn't meet expectations in terms of that inflation print, could add some volatility here as we look ahead to the rest of the week. That does for us today on Yahoo Finance, but keep right here. Akiko and Rochelle have you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita with Rochelle Akufo. Here's what we're watching at this hour. Final countdown. What should investors expect from the last 2 trading days or weeks of the year? We're going to hear from some expert voices this hour.
That's right, and a tale of 2 coasts. All week, we're bringing you key stories from the East and the West, kicking off today with the state of the economy. You won't want to miss it.
Plus, another Wonka is taking over the box office. The prequel starring Timothée Chalamet took the top spot at theaters this weekend. What the signals for movie theaters ahead of the holidays.
That's right, but first let's take a look at how markets are faring an hour and a half into the trading day. The Dow relatively flat there, up just about 18 points on the day. The S&P 500 up about 1/3%. We're seeing that energy and communication services, the strongest gainers, tech the biggest laggard. That's being dragged down by those reports about China expanding its iPhone ban across government and state firms. As you can see there, the Nasdaq, though, at least still in positive territory, up about 30 points on the day so far. Let's also check in on the Treasury market as investors continue to digest what they heard from the Fed, pouring a little bit of cold water on the Fed speak that followed. The 5-year yield, as you can see, up about 0.4%. The 10-year also gaining 0.8% on the day, and the longest-term 30-year yield, that's up more than 1% so far on the day. Well, taking a look at stocks moving relatively flatly as we near the final trading days of 2023. After 7 straight weeks of markets rallying, will stocks build on that momentum into year-end? Joining us now with more is Yahoo Finance's own Jared Blickery. Hey, Jared.
Hey, Rochelle, and just take a look at what's supposed to happen in the month of December. Liftoff in the back half of the month. Well, that's where we are now, but you might correctly remember that we are in the midst of a nice rally. In fact, if I plotted what has already happened in December, it would look something like this. It would be over 3% for the S&P 500, basically off the charts there. But if we do have historical norms, interplay here, we should get additional rallies into the end of the year. There have been arguments that some of that has been brought forward already, all the way back to Thanksgiving, but we see the incredible bullishness in the markets just continue. And here's another way to look at this. This is the S&P 500 average performance since 1950. This is the VIX average performance for the entire year going back to 1990, and we can interplay that with what's happened this year. That's in purple, and you can see into the end of the year, and I've shown this chart quite a bit, we do tend to see a depressed VIX, and then we get a little bit of a pop there. And it's worth remembering what happens in January, because the Santa Claus rally that we talk about, that's actually the last 5 days of December and the first 2 trading days of January. And then we have something called the January effect and the first 5 days of trading. Suffice to say that January is a very important bellwether for the entire year. There's a lot of political activity that's concentrated in the month of January. When we do have elections, new political officers and people in Congress coming in January, we have the State of the Union. That didn't used to be until later in the year. So all of these things tend to concentrate in January, and that's why it just has such prognostication ability for the rest of the year. And if we take a look at what's happened this year so far, I don't think anyone at the start of the year would have said, all right, well, after the drubbing we took last year, we're going to see Bitcoin up 150%, and we're going to see the New York FANG index, which is basically the Mag 7, up almost 100%. I don't think that was necessarily in the cards, but nevertheless, we are here. Innovation doing well. That's the ARC. That's up 62%. SOX. That's computer chips and software. Home builders for a little bit of diversification there. It's not all tech stocks. Home builders as well. So really interesting to see how this year has played out, and lots of expectations for the new year as well.
Yeah, plenty of positives to take away from there. Jared, as we count down to the end of the year, we're seeing the way people are invested in the market shifting. What have we seen in terms of stock ownership?
Well, Akiko, we just got this print. We have almost 60% of Americans' households owning stocks, and this is up from 30% in 1989. So this is a longer-term trend. And what I think is interesting here is that we really trended sideways once we hit the dot-com boom and then bust, and we can see we had this big rise in stock ownership into the late 90s, but after we got the dot-com bust, we kind of leveled out through the global financial crisis, had a few zigs and zags, did not really anticipate that we would accelerate because of the pandemic, but that's nevertheless what happened. And that has to do with the GameStop episode and the rise of the retail trader. That has taken that has elevated stock ownership to an entirely different level. And now I just want to show another chart. This is the retail cash on the sidelines. This has to do with the money market fund total net assets that are being held to take advantage of these high 5% rates. Well, if that money were to come into stocks, the reasoning goes, well, there's a lot of dry powder on the sidelines. Doesn't mean that stock ownership necessarily would go up. It doesn't mean that all households in America would own stock. And arguably, the households that have the most money are probably already owners of stock, but that doesn't mean that the dry powder that they have would have any less of an effect. So as far as the expectations for the new year, I think it's going to be another year for the retail trader without all the hiccups and the bumps that we had in 2021, kind of a coming of your own year for not only retail traders, but also for crypto, which is finally entering out of that, coming out of that crypto winter and into the crypto spring. So lots of anticipation here for the new year.
All right, Jared, with some of his forecasts for 2024. Jared Blickery, thanks so much for that. Well, just a few weeks left to go in 2023. The street's feeling pretty optimistic about the market's direction in the new year, but there's still a lot of uncertainty on the horizon. The timing of interest rate cuts and whether that long predicted recession may finally materialize. Two key big issues that investors are looking at. So what should the average investor keep in mind as they prepare their finances for the year ahead? Let's bring in Anthony Saccaro, Providence Financial and Insurance Services President. Anthony, it's good to talk to you. We've seen this huge momentum coming through in the markets since the Fed's decision last week. I mean, Fed officials would argue that maybe the market's getting a little ahead of itself, but I'm curious how you have framed the investment case going into 2024 on the back of the Fed decision. Has anything changed for you fundamentally?
No, fundamentally, everything is still the same. I think investors, the average investor would be smart to stay with the tried and true method of dollar cost averaging over time. I'm glad to hear Jared's report that the stock market investors are up at this point. I think he said something like 60%. I think that's where you want to be if you still have another decade and a half or 2 decades until retirement. Dollar cost averaging drives the average purchase price down. You're buying over and over and over. It's the same dollar amount, buying the same investments, regardless of the price of the investment. And what that has done mathematically is it lowers the average purchase price. And that's what you want to do, is you want to buy low. The fear that I could have at this point is the fact that people are feeling somewhat confident with what's happened in the market this year and what's happened in December. There was a lot of green on Jared's board. And I also don't want people to stray. This is crypto spring, as Jared talked about, right? Crypto market's done well. I don't want people to think, okay, well, maybe that's where I need to be. Let's quit dollar cost averaging. Let's quit doing the tried and true methods. Let's go put some money into crypto. No, I think that would be a mistake. You can put a small amount there, an amount that you could afford to lose, but stay with the tried and true. That, I think, is going to be the most important way to build wealth long run.
And Anthony, a lot of people have been waiting on the sidelines with cash in hand or had it in some of these shorter term funds as well, but they're trying to get in here, trying to sort of chase everything in this everything rally. How should they pick the best opportunities in this sort of environment?
Yeah, well, you have to be careful as well, because we're not out of the woods yet. This recession that seems to never have come, I don't know if we've been talking about it now for a year and a half or 2, but somewhere in that range, it still could materialize. We still have an inverted yield curve. We can't forget, inverted by about 50 basis points. And that's always been a good predictor of recessions. So someone with cash on the sidelines shouldn't just try to find that one moment in time. That's a fool's errand, trying to figure out, okay, I'm going to put it all in. If you've got cash in the sideline, I think there's 2 things to think about. One, if it's short-term cash, money that you're going to need in a year or 2 or 3, leave it on the sideline, take advantage of the higher interest rates while you can. But if it's longer-term money, what you don't want to do is you don't want to have a short-term asset, which would be like a money market or a short-term CD paying you now. You don't want to have a short-term asset to be funding a long-term liability, your retirement plan. So you should be dollar cost averaging that money into the market over time, not just trying to pick one point and get all in, but dollar cost average that money in over time, maybe over the next couple of years. That would probably be the right way to get in.
Anthony, bonds have been a pretty good place to be in if you consider where we have been the last several months at least. But we've seen a significant pullback in Treasury yields. Looking at the 10-year right now below 4%. Is now the time to maybe start shifting over more exposure to equities if you haven't done so already, given the expectation for the Fed now? Some are expecting 3 rate cuts.
Yeah, so I do think that yields going down is certainly going to drive the desire for more equities. Higher rates are going to compete against equities. Lower rates are going to help equities. So it's not a bad time to continue shifting. But I think it does go back to what is the purpose of your money. If your money is for longer term, dollar cost average your money out of the shorter term money markets and even the shorter term bonds and into stock market, which is going to be designed for the longer term. But I don't want you, if you're a younger investor, to get all out of bonds completely, because yields could still go down. If we have a recession and rates go anywhere to where they were, 6, 7, 8 years ago, then the fact is, actually even 2 years ago, then the fact is that's going to be good for the equity market. It's also going to be good for the bond market. So although bonds aren't as good as they were just in the last couple of months, if you have some percentage of ownership in bonds, when the rates go down, you're going to get some capital appreciation too, in addition to locking in decent yield. So I think as a younger investor, having maybe 30, 40, 50% in bonds is probably a good strategy as well too. Lock in higher yields and potential for capital appreciation in the next year or two.
And Anthony, speaking of what will be happening in the next year or two, obviously we have elections, still have a lot of geopolitical conflict at the moment. What do you think are going to be the biggest macroeconomic influences outside of what the Fed is doing?
Well, I do think the Fed is going to have some influence there. I think what happens with inflation is going to be a big deal. We don't know what's going to happen. Inflation's come down from its high of 9.1% a year and a half ago. Now we're in that 3% range. The Federal Reserve wants it down at 2%. And that last 1%, I think, is going to be really, really tough. But we're headed in the right direction. So inflation certainly is going to be a big deal. The wars are certainly going to be a big deal as well, too. It's amazing to me how much the market has kind of just shrugged off the wars going on. We haven't heard about Russia in a long time. Israel is the war that all the news was about when that first started happening. And it's almost like the market's not caring. Well, there are still very big reasons to care. And I think you don't want to let your guard down now. You still have to be vigilant. We still have a recession around the corner, potentially. Don't just go all in thinking that everything's good, because there could be a lot of problems next year and the year after.
Certainly not out of the woods yet by a long shot. Appreciate you taking the time to join us. Anthony Soccaro, Providence Financial Insurance Services President. Thank you so much.
Thank you.
Right, it's time for our trending ticker of the day. Shares of SunPower are tumbling after the maker of solar panels and energy storage products said there is, quote, substantial doubt the company can survive in a new regulatory filing. SunPower also noted it breached terms of a credit agreement over a delay in the filing of quarterly results. You can see solar stocks are in the red today, and some analyst reaction coming out of this news already. Goldman Sachs' Brian Lee downgraded SunPower from neutral to sell today and lowered its price target on the solar stock as well. Now, you have to wonder, obviously, we've seen when it comes to solar power, something of a pullback here. But I mean, year to date, clean energy stocks, it's been a bit of a mixed picture here. But some of this comes down to the business fundamentals when it comes to particularly to SunPower, versus the broader industry trends, as we see people looking to nuclear and other ways that are perhaps cheaper of bringing more power. But interesting to see this SunPower really taking a hit here, down more than 35% so far.
Yeah, Rochelle, when you think about renewables, the long-term case appears to remain intact, but there's been a lot of jitters in the space in general around the huge capital costs that are involved, the investments that are necessary, and then what that means in a higher rate environment. So SunPower, just the latest here, getting that hit, but we saw that with, for example, Plug Power just last month when they talked about a going concern, and that led to a huge drop in the stock. As it relates to Goldman's note, though, some interesting, I would say, notes coming through here, specifically talking about the pressure, the price pressure the company's likely to face with increased competition. Goldman's revenue estimates for SunPower, 20% less than the consensus for 2024, and then 15% less for 2025. And we should point out their price target's at $4 a share now, and we're right around that. But the stock is down, what, 70 77%, well over 70% on the year. So certainly not been looking good for SunPower, to say the least, Rochelle.
Indeed, we'll continue to keep an eye on that stock for you. All right, we have all your markets action ahead. Stay tuned. You're watching Yahoo Finance. The US economy defied recession fears in 2023 and made substantial progress towards a soft landing, but it's too early to declare victory just yet. Our next guest says there are a few risks that could set back the Federal Reserve's fight against inflation. For more on what's in store for the Fed next year, we're joined by David Miracle, Goldman Sachs chief US economist, as part of Yahoo Finance's 2024 Investor Guide. Thank you for joining me this morning. So let's break down the Fed's fight here on the recession that either is or never was, and the likelihood of a soft landing.
Sure. Look, I think in the last half year, things have gone very well. Inflation's come down very sharply, it turns out, from the first half of this year, running at about a 4% annualized pace, to the back half, running at what we think will turn out to be a less than 2% pace. All of that has happened, of course, despite GDP growth growing above 5% annualized in the third quarter, and looking fine in the back half of this year as well. So I think that the soft landing has gone from on track to largely here, in the sense that the underlying inflation trend now looks to be pretty close to 2%. And the labor market has rebalanced as well. If you look at many measures of labor market tightness, on average, we're not in that different of a place than we were in 2019. All of this has happened a lot more quickly than we had anticipated over the last several months. As the inflation data have rolled in, we've made some downgrades to our inflation forecast. And I'd say broadly, the change is that rather than gliding into the mid-twos next year, which would have been, I think, a perfectly good outcome, it now looks like instead we are sort of abruptly finding ourselves more or less at a 2% underlying pace.
You said that you now specifically see only a historical average, 15% chance of a recession. As you look to 2024, what would likely tip it in that direction?
Sure. So back in September, we cut our recession odds down to 15%. And the thought process there was basically that the two things that had worried us over the last couple of years, first, this question of can we really solve the inflation problem without a recession? And then the question of will the regional banking stress produce a recessionary credit crunch? We felt like we had learned enough that those didn't really look like risks that were more serious than the risk you would have in any environment. On the first question, inflation, we've made a lot of progress in reversing overheating, rebalancing the labor market, slowing inflation, and basically fully normalizing inflation expectations. So at this point, I would say that does not look like the risk that it was in mid-2022. On the banking stress, I think that was a perfectly valid thing to worry about in real time during the spring. Certainly could have evolved in a worse direction. But at this point, banks seem to have avoided worst case scenarios. They seem to be lending at a pace that certainly is down, but not any worse than you would have expected just based on the rise of interest rates, or at least not much worse. And non-bank lenders have also stepped in to lend a bit more where the regional banks have cut back, which has softened the blow. So at the time, those two issues, those two concerns had led us to raise our recession odds for the following 12 months to a peak of 35%. But back in September, we brought that down to 15%. And we've left it there since because we feel like we have a handle on those problems and they just don't look like elevated recession risks. Going forward, what could go wrong next year? I think it probably at this point has to be something of an external shock to the economy. Of course, recession odds are never zero. The last time I would have said that I didn't see any elevated risks on the horizon was late 2019. So that's a reminder that things that are maybe off the radar can always pop up. And that's why the odds are 15% and not something lower than that.
And to that point, I mean, if we look at the fluctuation that we've seen with oil prices, at one point, some of the estimates were saying, oil could hit $100 a barrel. We saw it temper, now ticking back up towards the end of the year. How much are geopolitical tensions and what happens with oil prices? How high should they be on investors' radars?
I'd say certainly whenever there's a war in the Middle East, it's a valid thing to worry about. So far, of course, since war broke out, oil prices have fallen somewhat rather than risen. And I think the price of oil would be the main transmission channel to the US economy. Certainly, there's still some risk there for next year. We are not looking for a particularly explosive increase in oil prices that would reinvigorate inflationary pressures, but certainly there's some uncertainty here. What I would emphasize, though, is that 2024 should look a little bit different from 2022, when the outbreak of the war in Ukraine also pushed up food and energy prices, in the sense that in 2022, we were already struggling with a fairly large inflation problem. So back then, the spike in energy prices came on top of a sense that inflation was already rising in many areas and fears that it might continue to do so. If oil prices were to rise meaningfully next year, and that's not our baseline expectation, I think it certainly would push up inflation a bit, but it would be a more isolated shock. And I think for that reason would probably pose less danger of unanchoring inflation psychology.
Finally, David, while we've seen the market sort of run ahead on the expectation of sort of the end of this higher rate environment, or the Fed pivot, if you will. We have seen a record or high number of corporate bankruptcies this year, the highest number we've seen since 2020. Roughly 600 is the number we're looking at right now. Are we likely to continue to see the fallout from the higher rate environment going into 2024, even though the medium-term trajectory, at least as it relates to the central bank, is starting to look a little better?
Yeah. So you're right that corporate bankruptcies have been rising, but I think it's important to compare these sorts of statistics to pre-pandemic levels rather than just to pandemic levels. Over the last few years, many different macroeconomic measures of, essentially things going wrong in the economy, whether that's corporate bankruptcies or layoffs or defaults and delinquencies, were about as low as they've ever been. And I think part of that was because the fiscal support to businesses meant that many were able to kind of make it through those difficult times. The fiscal support to households, coupled with reduced spending needs, meant that people were able to pay their bills. And the very tight labor market meant that not many people got laid off. There's plenty of room for all of these measures to rise without in any way signaling that the economy is in a recessionary state. And that's how I would interpret the bankruptcy statistics. They are still actually quite low relative to where we were pre-pandemic. And where we were pre-pandemic, that was one of the best labor markets, the best combinations of low inflation and low unemployment that we had had in quite a long time. So I don't take a worrying signal from the rise in any of these measures just yet. For the most part, they're still below where they were, even in that very strong pre-pandemic economy.
Yeah, some important context there, even with those numbers higher. David Miracle, Goldman Sachs chief U.S. economist, appreciate you joining us today.
Thank you very much.
All your markets action ahead. Stay tuned. You are watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement. What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there is more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance.
More Chinese agencies and government-backed firms are banning the use of iPhones and other foreign devices from the workplace, according to Bloomberg. Back in September, reports suggested a small number of Beijing agencies told staff to leave foreign devices at home, though officials have denied the rumors. The latest news raises concerns about Apple's future in its largest foreign market. Sales from China have roughly tripled over the last year. The market now accounts for 20% of Apple's revenue. Rochelle, this is one of those concerns that's kind of been percolating in the back for Apple investors. Tough to see how far this goes, given that there's been no official stance from the government. But now we're talking about 8 different provinces. So certainly, significant escalation if that's the case. I guess the question for me is, how much of this is about retaliation against Apple for U.S. policies on tech companies? How much of this is about boosting the homegrown players like a Huawei?
You have to wonder if it's a mix of both, because obviously they wouldn't come out and directly say, this is in response to, some more of the pressure that we've seen from the Biden administration on technology coming out of China. But the fact that this has now expanded to now those 8 provinces, and we're seeing it also going into some of the more rural areas, reportedly these workers being told not to bring their iPhones, but also other Western phones to work, according to those unnamed sources that are cited in Bloomberg. But Apple really bearing the brunt of this. And so you have to wonder about this dance here. We've seen Apple obviously still focusing on China as a manufacturer of its iPhones, but really sort of hedging its bets, looking elsewhere, looking at India to make sure that it's not so concentrated in a country where you could be subject to a lot of these geopolitical whims. But interesting to see if this is going to mean that we see a greater adoption of Huawei phones, or if this is just about really targeting Apple and the US here.
Well, Samsung also getting hit as well, Rochelle, we should point out. So it's not just about, Apple obviously huge, China is a huge market for the company, but Samsung, to your point, it's not just about one player there. So we'll be watching, to see just how this expands beyond where it is right now.
Indeed, we'll wait for some official word, whether it's to confirm or deny the allegations. Well, over the weekend, the Teamsters Union voting to authorize a strike at AB InBev breweries. Now, the union is fighting to secure a new labor contract for its 5,000 members at 12 U.S. breweries. For more on this, we have Yahoo finance reporter Brooke De Palma here. So, Brooke, walk us through this.
Yeah, good morning, Rochelle. As you noted, over the weekend, the Teamsters Union, they authorized the strike. And of course, it's important to note here that they're not necessarily striking, but they authorize a strike that if the company fails to reach a contract, then they will strike. Now, this is a looming deadline. The contract expires on February 29, 2024. So we still have roughly 2 months for Anheuser-Busch to come to the table to reach a new contract with this union. But the union is seeking an agreement with improved wages, job protection, as well as health care and retirement benefits. So the Teamsters Union really looking for Anheuser-Busch to come to the table. In the release, the union also called out that $1 billion stock buyback that the company announced following its Q3 results that will be executed by, then over the next 12 months. So those results were back in October, so it's currently underway. But they took issue with that, saying that they're providing those buybacks to, quote, wealthy investors as it simultaneously ignores the need to protect good jobs. Now, Anheuser-Busch responding to Yahoo Finance with a statement saying that they are aware of the Teamsters strike authorization vote, which they said is common during these labor negotiations. And they added that they're committed to negotiating good faith with the union to reach an agreement that recognizes and rewards the talent, commitment, and drive of our employees. But of course, this is just one obstacle that Anheuser-Busch has yet to face, and one of many that it has had to face so far this year.
Brooke, what's the expected impact to AB InBev if, in fact, this strike does go through?
Yeah, well, right now, shares of AB InBev largely flat. But of course, this is just not one beer. It's not just Bud Light that Anheuser-Busch is largely known for. They make Budweiser, Bud Light, Michelob Ultra, and Busch. So far, we're not seeing investors too fearful of this looming strike. But it's important to note that, as I noted before, this is just one of many obstacles that Anheuser-Busch has had to climb over so far this year. Shares up, though, year to date up 4%. But we have seen volume volumes take a hit this year. As of Q3, volumes declined by 3.4%. Beer volumes alone up 4%, where just non-beer volumes grew by 1.4%. So a bit of a mixed bag there. But largely, we're seeing investors not too fearful. But it's important that these workers, of course, are there as Anheuser-Busch really looks to rebuild its following. We know that this year Modelo took the top spot from Bud Light, and Molson Coors also gaining share. And so 2024, a crucial year for Anheuser-Busch as they look to double down on that fan, particularly that sports fan, and continue to increase marketing. Of course, it's important to note that their workers will be there to meet, they hope, an uptick in demand.
Yeah, just the latest labor strike, or potential for a labor strike, I should say, in a year filled with them. Brooke DePalma, thanks so much for bringing us the very latest on that front. All your markets action straight ahead. Stay tuned. You are watching Yahoo Finance. Oil prices on the rise today, but we are seeing gas prices here at home on the decline. Here with the latest, our very own Inez Ferre. Inez, this has certainly got to be good news, at least on the inflation front.
Oh, for sure. For drivers that are looking to fill up their tanks, they are seeing lower and lower oil prices. In fact, gasoline prices. For the last 13 weeks, we have seen a downward trend in gasoline prices. That's the average that you're looking at nationally. That's according to Gas Buddy, $3.03 per gallon, just 3 cents off of that $3 per gallon level. So and I've spoken to several analysts, and they are predicting that, yes, by the end of the year, if these trends continue, you are likely to see sub $3 per gallon levels across the U.S. Of course, California, where you're at, Akiko, is a little bit pricier, but still we have seen prices decline there as well. And 31 states right now, according to Gas Buddy, are seeing prices under the $3 level. Now, even OPIS, which is a pricing agency, has said that in about more than 60% of fueling sites across the U.S., you are seeing those prices below the $3 level. And that is sort of also a psychological level as well for many drivers when they go to fill up their tank. But it is also a big relief for consumers. In fact, OPIS data is showing that last year, when you saw the prices above $5 per gallon on a national average level, that was in June of 2022, you had consumers that were spending a total of $1.9 billion per day on gasoline. Today, that is $775 million less. So it is a huge relief for consumers. Also, diesel prices are on the decline as well. You're seeing diesel prices, according to Gas Buddy, at $3.99 per gallon, just around that $4 gallon level. Yes, definitely this bodes well with the fight against inflation, guys.
Indeed, and certainly helps set that winter blend of gas also cheaper as well. So some welcome news for the consumer. Appreciate you as always, our very own Ines Ferreira.
Thank you.
A tale of two coasts. As we get ready to say farewell to 2023, let's check the pulse of two key economic hubs in the US, California and New York. Now, two of the largest states in the nation by GDP, they play an outsized role in the economy, with California's tech hub up north and Wall Street in New York City. Now, labor was a big issue on both sides of the country, with layoffs in tech and the financial sector, as well as the Hollywood strikes taking a toll as well. The unemployment rate in both states is higher than the national average at 4.8% in California and 4.2% in New York. So how is this impacting the move from coast to coast? We have Sarah Bone, Public Policy Institute of California Vice President, and Thomas Simons, Jefferies money market economist. Welcome to you both. So Simon, I want to first start with you, being that I'm a fellow East Coaster. So talk about the dynamics here that are at play, because when people think about the New York economy, you have a lot of these big headlines making it seem like the economy is in trouble there, but give us a reality check.
Yeah, I think that those headlines are really focused on some certain dynamics that are very idiosyncratic, right? So obviously there's a lot of pressure on the commercial real estate sector as it relates to office space. But if you look outside of that, the economy in New York is actually doing pretty well. I would say that, I mean, just on an anecdotal basis, there are far fewer, sort of spots for rent in, higher end retail sectors. I mean, I happen to work between Madison and Fifth Avenue. And so I have a really good opportunity to get kind of immediate survey data, we'll call it, from people who work in those higher end retail businesses, and also just kind of a temperature gauge of who's walking around on the street. And I would say that whether it's the return of certain tourists from areas that maybe were restricted from travel before, or just a kind of general surge in domestic tourism as well, we are seeing the crowd levels sort of back to where they were in 2019, for instance. So I think that there is also some untapped potential from more return to office type activity, and also you mentioned the financial sector being kind of a dominant force here. For the last couple of years, depending on where you are in the financial sector, it hasn't been, some of the greatest years with interest rates having risen so much, and the markets, kind of been very difficult. If we see rates fall next year, we could see, even a greater surge in activity from that sector as well.
Sarah, we've been talking a lot about the major companies out of California, but obviously California made up of more than just tech companies. You've said that there is still a lot of pessimism around the state economy, despite the relative strength that we're seeing. It seems to pretty much be on par with what we're seeing nationally. What's leading to that pessimism in the state?
In my view, the pessimism is really about prices and inflation. There are such signs of strength when we look at the economy in California. Of course, it's not all. There are sectors and areas that have a bit more challenge, but overall, the economy here is quite strong. But Californians are very pessimistic. 2 out of 3 believe that the economy in the state will be kind of worse next year than it is now. And we've seen this pessimism for a few years. Californians are not feeling great about their personal finances. They're not seeing them on the up in the next 6 months. And I really do think that that boils down to prices and inflation. Costs were already higher in California before the pandemic and before the recent surge in inflation, and now are even higher. So kind of overall, prices up 19% since before the pandemic. Even if there are kind of areas where we see improvement, whether it's in gas prices or in rents, it's still on paper, or it still feels to families and businesses like it's just really kind of hard to get ahead. A lot of that, we look at wages, and wage growth has been super strong. So on paper, it looks like a $5 an hour wage increase for Californians on average. But after accounting for inflation, it feels like a $1 an hour pay cut. So just really, harder to kind of get ahead. Californians are not feeling confident about making large purchases. 75%, according to our recent survey, said that they're less comfortable making big purchases than they were even 6 months ago. So I think we have a lot of room to improve on both kind of, the price side, which would be great, but also on, the wages, the earnings, whether it's a business or a worker trying to get ahead kind of on that side of the calculation, there's a lot of room to improve.
And Thomas, to Sarah's point, obviously, if you have wage growth, but it's still not keeping pace with inflation, you're not going to feel as if things are going well, even if you're seeing gas prices go down. How does that pessimism then trickle into other aspects of the economy, things like consumer spending and whether or not people choose to change jobs?
Yeah, I mean, if you think about New York City specifically, which, I should note is not all of New York State, but if we're thinking about the city, gas prices actually don't matter that much to most people who live in the city. Now, I frequently talk to people who don't own a car or, find it very novel to even ride in a car in New York City. So the real pessimism, kind of is sourced within housing costs, right? I mean, like we've seen a lot of, kind of headlines that suggest that rent prices are coming down. There's all this supply of multifamily housing coming onto the market. But that's really a lot of projects that are focused in the Sun Belt and in a lot of areas that saw inflows of population from people leaving the city. I don't think that there's a lot more, really affordable housing that's been sort of generated within New York. I think that there are some big real estate development projects that have affordable housing as components of them, but they tend to be in the later phases of construction, which we haven't quite hit yet. So overall, I think that there is a big affordability problem within the city. I don't think that we're particularly close to seeing that, kind of find some relief. But, the fortunate thing for New York is that, a lot of its economy is based on people who don't live in the city who are coming into it. So I think that, the people who live in New York are probably feeling a lot of that same pressure that that Sarah was talking about. And I don't see a whole lot of relief coming anytime soon. But, people who are from other places are bringing in, plenty of economic fuel to continue to foster further growth.
Sarah, let's pick up on that point that Thomas made, because I will tell you, as somebody who lives in California, how many conversations I have that revolve around the cost of living and the lack of affordability when it comes to housing. That has led to a pretty substantial exit out of the state for those who say, look, I just can't afford to live here. How much of that do you think leads to some kind of correction in the market within the state?
That is a good question. We are monitoring closely these trends in population. During the pandemic, California saw a loss in population, fewer people coming in, and actually more exits than we'd seen in prior years. Even among kind of high income earners who, can, ostensibly kind of afford the cost of living to get kind of reap the benefits of being in California. So we're not sure yet if that is, a temporary correction, something that, remote work maybe drove, or if that is a new trend, that there is a turnaround in the draw of California because of housing prices and other costs here. It's definitely something that California will be watching. We have been, I would say the state government, multiple governors, lots of leaders have been working on what kind of policy could help address the housing supply that is concern that has been building for decades, and really constrains consumers and residents in finding the housing that they want, that they can afford. And so, that's like takes a very long time to like make the corrections in the system that can then flow to private developers and ultimately to those looking for housing. So that's definitely a critical piece that California is focused on. But I would say, even, there's some bright spots there, and I'm pretty optimistic, but that will take a lot of time to kind of filter through. And at the same time, unless some of this like draw of California due to the amenities that we have, as you know, at Kiko, our weather and other things, unless those amenities really like become less of a draw to people coming to California, our prices are likely to remain higher here than elsewhere. So, I think that's just a reality that we're going to be living with, unless we're in a new world really in 2024 and beyond.
Yeah, Sarah, I guess it's all relative. If you're moving from New York, you're coming to California, you're saying, hey, I get a little more space for this high cost. So it doesn't always balance out there. But Sarah Bone, Public Policy Institute of California Vice President, and Thomas Simmons, Jefferies money market economist. Good to talk to both of you. Really appreciate the time.
Thank you.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Another Wonka is taking over the box office. The prequel starring Timothée Chalamet took the top spot at theaters this weekend, bringing in $39 million in the US. For more on this, we're joined by Yahoo Finance's Alexandra Cadal. We know there's always big shoes to fill here, ever since Gene Wilder and then Johnny Depp. How did Timothée Chalamet do?
Well, Rochelle, I would say it was a pretty sweet opening for this remake, no pun intended. As you mentioned, an estimated $39 million domestically. That brings the global total to just over $150 million. Now, this was higher than box office watchers had been projecting, but it was a big push from Warner Brothers, which had heavily been promoting the film. Solid ratings as well, 84% critic score on Rotten Tomatoes with a 91% audience score. So the hope is that with these solid ratings, there's going going to be continued word of mouth and that these box office dollars can tick higher through the end of the year. It's also a solid start for the live action musical. We've really seen that genre struggle over the past few years. You think of films like West Side Story, Dear Evan Hansen, In the Heights. Those films largely underperformed, and I personally enjoyed all of them. I'm a musical kind of girl, but didn't quite resonate with audiences there. Now, if we want to compare the current remake, you mentioned the Johnny Depp one, bit of an underperformance compared to Johnny Depp. That remake pulling in $56.2 million compared to the $39 million of the current one with Timothée Chalamet. But we do know that the box office has been going through the ringer since 2005, which is when Charlie and the Chocolate Factory premiered. According to ComScore data, if we take a look through the end of the year, what we could possibly see right now, $8.6 billion at the box office. The hope was that we could get to $9 billion, considering we only have a few more titles left to debut until the end of the year. Not quite sure we'll get there, but still, this is the best performance for the box office since COVID really upended the entire industry. Certainly better than last year, where we had $7.46 billion and 2021's $4.56 billion tally. But we're still not quite back to those pre-pandemic numbers of between 10 to 11 billion. And it's possible we might not ever get there as more movies go direct to streaming and consumers really are more selective about the movies they want to see in theaters. But we'll see if we can hit that 9 billion number, especially considering all the labor strikes. I think that would be pretty solid.
Yeah, a positive way to end the year in a tough year in the space. Ali Canal, thanks so much for that. That does it for Rochelle and I in this hour. We've got much more to come here on Yahoo Finance. Keep it right here.